Ever wondered what separates the average trader from the millionaire trader? In this audiobook, Millionaire Traders by Lien and Boris Schlossberg, we go behind the scenes with real, self-made traders who have beaten the odds and built fortunes in the markets. Hey everyone! If you're into trading, investing, or just curious about the mindset of market pros, this summary is for you. Today, we're diving into Millionaire Traders, a powerful audiobook that shares the real-life experiences, strategies, and lessons from successful independent traders around the world. Millionaire Traders is not your typical how-to guide. Instead, it's a collection of interviews and stories from everyday people who made it big in the world of trading. From day traders and swing traders to currency and futures traders, each chapter reveals a different personality, strategy, and approach to risk management. You'll learn the psychological battles traders face every day, how different traders approach technical vs. fundamental analysis, the importance of discipline, adaptability, and managing losses, real-world insights into developing a trading system that works for you. Why consistency often beats brilliance in the long run. The authors, Lien and Boris Schlossberg, both seasoned FX strategists, add expert commentary to distill the lessons and highlight patterns that emerge across these diverse trading journeys. Who should listen to this audiobook? This book is perfect for aspiring traders looking to learn from real-life success stories, intermediate traders who want to refine their mindset and strategies, investors curious about the human element behind trading success, finance students or enthusiasts interested in the psychology of markets. Anyone who wants to understand how ordinary people can achieve extraordinary success through discipline, patience, and a relentless pursuit of improvement. Final thoughts: Millionaire Traders is inspiring, insightful, and packed with actionable lessons. It doesn't promise quick riches, it shows what it really takes. If you're serious about trading or just love a good success story, this audiobook deserves a spot on your playlist. Give it a listen, you might just find the strategy or mindset shift you've been searching for.
Millionaire Traders: How Everyday People Are Beating Wall Street at Its Own Game by Lien and Boris Schlossberg. Chapter 1, The Art of Trading. It ain't about how hard you hit, it's about how hard you can get hit and keep moving forward. That's how winning is done. Rocky Balboa. Trading is a battle between you and the market. The traders we interviewed for this book have offered a wealth of insight into the art of trading. We have distilled their most important ideas into this short summary, highlighting one unique idea from each trader that can help you succeed in your battle with the markets. 1. If the news is good but the stock plummets, buy the crash. Buying crashes is not for the faint of heart. For many traders, the experience is akin to jumping out of a plane without a parachute. Yet Dana Allen has made his living doing just that. How does he profit from other traders' losses? By looking for telltale signs of divergence. Technical divergence setups, where price makes a new high but momentum indicators, do not is one of the bread and butter routines of many successful traders. However, Dana Allen takes the idea one step further by trading fundamental divergence. He likes to buy stocks that sell off on good news, speculating that the initial reaction is often simply due to short-term profit-taking. Once the sellers are done, Dana likes to scoop in and buy value at a cheap price, and then quickly resell it higher once demand reappears. By making sure that he only buys quality companies with good news, Dana has the fundamental support for his trades and more often than not is able to bank gains in the process. 2. Know yourself, know your trade. In trading, knowing yourself is more important than any particular trading strategy that you may choose. Your personality needs to be in sync with your methodology, otherwise you will not be able to follow the rules of the setup. Knowing your strengths as well as your limitations is rule one of becoming a successful trader. As Rob Booker points out in his interview, I am a 50 to 100 pip a week trader, meaning I have pretty much decided that that's about the limits of my human capacity, and over 50 to 100, I start getting a little bit crazy. I become a little bit less disciplined and a little bit more euphoric, to put it mildly. So, I have not generally done a lot to increase that pip target over time, even though systems that I build might produce bigger gains. If you have a short attention span and seek instant gratification, long-term swing trading strategies will not work well for you, no matter how robust they may be, because you will not have the patience to successfully see them through. Conversely, forcing oneself to become a scalper is sheer suicide for a trader who may be much more analytically, rather than instinctually, inclined. Therefore, it is imperative that you know what type of trader you are and trade within your comfort zone. There are many ways to succeed in trading, but they must be aligned with your personality. 3. Revenge is never sweet. The most dangerous time for any trader occurs right after a major loss. The instinct for revenge trading, the desire to get it all back at once, can be far more damaging than the initial loss, leading many traders to make impulsive, irrational decisions that often lead to complete destruction of the account. Therefore, traders would do well to heed Chuck Hayes' advice, which could save them from needless ruin. Revenge trades are the most costly trades. If you have a bad trade and you try to make it all back at one time, you're going to lose more money. I think I learned from experience that the best thing to do is to try and get back and get even a little bit at a time. It's a whole lot easier to make a half point on a 100 contracts than it is to make 10 points on 10 contracts. I just try to focus on making good trades, do the same thing over and over again, and string together some singles. By chipping away at his losses, Chuck focuses on re-establishing control over his trading by assuming less and less risk until he has slowly recovered his losses. This strategy stands in sharp contrast to what many novice traders do, which is to create even more risk by trying to hit home runs after a large loss, and shows why Chuck is one of the premier traders in the game. 4. Triple your demo twice before trading for real. This insight from Hussein Harnecker is perhaps the most practical piece of advice from any of our superstar traders. Nobody can master a professional skill right away. Doctors practice on cadavers, lawyers spend countless hours in moot court, and mechanics toil for months in classroom garages. Practice does not guarantee success, but lack of practice almost always ensures failure. In foreign exchange, which is Hussein's market of choice, every dealer offers a practice platform allowing traders to experiment with virtual money rather than real capital. In other financial markets, plenty of software tools exist to allow the trader to paper trade in realistic market environments. For example, our other interviewee, Paul Willett, who was already a successful equity trader, spent 3 months paper trading his account when he decided to make a switch to electronic stock index futures. What makes Hussein's advice even more valuable, albeit much harder to follow, is that one has to achieve substantial success on the demo before moving to a live account. By mandating that you triple the demo, Hussein requires that your trading methodology has a discernible edge that should serve you well in the real market. While his rules of trade are difficult, they are well worth following because they instill the discipline necessary to succeed in the real market. 5. Don't lose your cool, always use a stop. Although this rule is practiced by every professional trader to control risk, Frankie Law, the Forex FX trader from Hong Kong, offers additional insight into why it is so valuable. In his interview, he states, "There are many people who will go long a currency pair and keep injecting money into their accounts if they get margin calls to buy at even lower prices in hopes that a rally will help them to recover their entire account. For example, if you are long 10 lots and the price falls, you add 20. If it falls again, you add 30, etc. Although the ability to recover quickly may seem extremely attractive, it is very dangerous, and it is something I will rarely use. The reason is because I feel that if I keep on posting money into my account to meet a margin call and adding into a losing position, I am essentially at the whim of the market. I can only hope that the trade moves in my desired direction, but I am essentially stripped of my decision-making power. Perhaps the price movement would have called for a short, but since I am buried so deep in the long position, I can only let the market take me where it wants to. So what would I do if I got a margin call? I would close my position and wait for the next clear opportunity or setup to get into the market, because it avoids letting the market dictate my profits and losses and allows me to be the decision maker once again. I get to choose when to get into the market, what product, and what size, and this control is very important to me. If you do not use a stop, you are at the mercy of the market and lose all control over your trade. Since trading at its core is ultimately an exercise in control over the chaotic and often unpredictable markets, a stop is a must for any long-term trading success. 6. Protect your capital. Protect yourself. This is perhaps the most basic but often the most overlooked aspect of trading. According to Indy Jones, Clint Eastwood would be a great commodity trader because he told the $1 million baby that rule number 1 in boxing is to protect yourself. And I think the same is true in trading. If you want to trade, your capital is everything. So if you want to be a great trader, you have got to protect that capital. No capital, no trading, no life, and it's the same whether you want to be a $1 million baby in boxing or a $1 million baby in commodity trading. I think it's the same thing. Protect your capital. The market will forgive many things, including bad, even stupid trades, but it will not forgive the loss of capital. Once all of your capital is gone, there is no opportunity to recover. That's why capital preservation is always the foremost concern of every trader we interview. 7. Averaging down is for losers, but averaging in can be the difference between success and failure. Most traders will tell you that averaging down into a trade is a mug's game. However, averaging in is a strategy employed by a number of our interview subjects to a great success. What's the difference? Intent. Traders who average into the positions expect to be initially wrong on price and size their trades accordingly. Roland Campbell is one such trader that to me is absolutely the key to my success. I average in on every trade I make and I average out whenever I exit. I have a tendency where, as soon as I buy a currency, it will dip 10 pips. Before I would get upset, but now I love it because I feel like I can get in at a better price, so I hope it dips another 10 pips. I know the price I want, so I will average into that price. Roland allows himself about 4 average ins before he calls it quits. If it goes much further than 4 average downs, I have to start considering whether this is the right trade to be in, he notes. But 9 times out of 10, that strategy works for me. Roland always knows his uncle point, and unlike novice traders who are never willing to pull the plug on a bad idea, Roland will always stop himself out when a trade goes bad. However, in the majority of the cases, he will succeed in turning a profit on most of his scale and strategies, showing once again that all rules of trading can be broken as long as they are done so for a good reason. 8. Tops or bottoms are only evident in hindsight. There is an old trading adage that goes like this: they don't ring a bell at the top. While tops and bottoms may seem obvious in retrospect, in the heat of the battle they are rarely clear. That is why Tyrone Ball's point is so valuable. He said, I came to understand that you can't pick the top and the bottoms of your trades. You just got to be willing to take money while it's still in your favor and cut your losers small. I mean, it sounds too simple, but most can't do that. Market profits can be very elusive, like ice cubes in your hand. Therefore, banking at least some profits when you get them is a cornerstone to most of our traders' success. 9. Turn happens only once, but trend is continuous. For anyone who is a fade trader trying constantly to pick tops or bottoms, Ashken Baller's deceptively simple observation should provide a moment of pause. He states, basically, I am continuation trader. When the trend is going in that direction, I don't see any point in trying to find the turn. It will tell you when it's reversed. If you look at any chart pattern where the market's reversed, you'll see a daily reversal. Reversal only happens once, but the continuations happen all the time until the moment the reversal is hit. In a sense, Ashken argues rather persuasively that the higher probability trades occur with the trend since, like in physics, price will stay in motion until it is counteracted by a stronger opposing force. Until such time comes, Ashken believes, it is much more productive to trade in the direction of the major trend. 10. The last 25% of the position can make a disproportionate contribution to your overall profit. Everyone wants to be able to let their profits run, but in real life, financial instruments rarely follow a smooth, straight path to riches. Instead, prices often retrace the majority, and sometimes all of their gains, leaving many inexperienced traders empty-handed. Paul Willett, however, has come up with a method to harvest some profits right away while ensuring that he can still benefit from an occasional extension run in his favor. What's noteworthy about his insight is that even leaving a small proportion of his original position on could contribute significant profits to his overall account. How does this work? Let's assume that we trade like Paul does with a position of 20 contracts. The stop on the position is 1.00 ER, a mini Russell 2000 stock index future point. At plus 1.00 points in his favor, Paul would sell 5 contracts and move the stop to break-even. At plus 2.00 points, he would sell another 5 contracts. At plus 3.00 points, he may sell an additional 5 contracts. At plus 5.00, he may sell 2 more contracts, and at plus 7.00, he may finally sell the last 3 remaining contracts. In total, the trade would have netted plus 61 points, but note that fully 31 of those points, or more than 50%, came from the last 5 contracts, or just 25% of the original amount of the trade. Paul teaches us that we do not need to make money on more than a small portion of our position in order for the whole trade to be substantially profitable. 11. Make your money work for you. In a rush for capital appreciation, many traders often overlook the immense power of compound interest. Marcelino Lien is not such a man. Instead, much like the largest money center banks and the savviest hedge funds in the world, Marcelino always looks to get paid while holding a position. This is the reason he trades FX exclusively on the side of the carry, letting the positive interest rate differential between the currencies work to improve his average entry price, while he waits for his trades to become profitable. While his method may be far less glamorous than the swashbuckling style of the scalpers, it is no less profitable and should be taken just as seriously. 12. Beat computers at their own game by using probative orders. Almost 70% of trading on NASDAQ is now done through automated order entry programs. Many traders have bemoaned the onset of computerized trading robots as the end of face-to-face markets. But Steve Icow has not only adjusted, but prospered under the new regime by probing out the logic behind the software algorithms. Steve says, "A high percentage of NASDAQ volume is now composed of black box trading, so a lot of times I will test price just to see where the market is. Let's say I am long and I start bidding up and bids come with me, then I know I am good. Let's say I offer and now no one joins me. No one is an aggressive seller. That's how I get information on the stock, by constantly bidding and offering." Whether you are a machine or a human being, when it comes to financial markets, ultimately, you are either a buyer or a seller. By constantly probing the logic of the machines, Steve Icow is able to figure out their true intentions and turn that information into profitable trades. Chapter 2. The Man Who Buys Crashes. Dana Dan Allen. Ever since he was a little boy, Dana Dan Allen was fascinated with trading. He started reading the Wall Street Journal at 9 and opened his own commodity trading account by the time he was 21. Dana's trading career has been characterized by one overarching theme: the uncanny ability to buy $1's worth of value for a nickel. Be it commodities, stocks, or options, Dana has succeeded in finding deep value in whatever instrument he traded, often increasing his initial investment tenfold. The man who buys crashes, Dana Allen, thrives on making bids when most other market participants are running for the exits. Although his trading style is not for the faint of heart and can be seemingly chaotic, Dana has managed to face the risks and walk away with returns that most retail traders can only dream about. We had a chance to interview Dana from his home in Nevada. Were you always fascinated with trading? Did you read the Wall Street Journal when you were in high school?
Oh, younger than that. I started reading it when I was 8 or 9 years old. I'd look at the commodities section and at the charts, and I always thought, gee, I can make money in this. Of course, I was too young. But when I was 21, I think right on my birthday, I started trading commodities. So I guess at that point I had to be the youngest commodity trader in the United States at that time.
When you say you started trading commodities, were you trading retail?
Yeah, I was. It was back in the very bad commission days. I was still in college and I was trading mostly copper because I was a geology student.
What were the commissions like at that time?
Oh, outrageous. Yeah, it was so bad. I think it was $50 to $100 a side or something like that. It was terrible.
And how much was each point worth?
It was $250 per penny.
So copper had to basically move a penny for you to overcome the commission costs, right?
That's right, it had to be a fairly big move. Back then, my broker had to pay $600 a month for a 5-minute delayed quote fee, which provided as much information as anyone can get free now. These days, everything is so much better. The information is free and it's faster. The commissions are 1% of what they used to be. I can do options, and the commission is $1.50 to both buy and sell, where it used to be like $50 each. In many ways, it's never been better than it is today to trade.
Did anybody in your family trade stocks?
Yes, my father did as an investor, but he was a businessman, not a trader. I started off doing it myself, and then, like most people, I started with the minimum account size of $3,000. And sure enough, you always have to blow up when you have such a tiny account.
How long did it take you to blow up?
Oh, I think 6 months. That's pretty good when you trade commodities on $3,000.
That is pretty good. That's very impressive. You really held out. You treaded water for a long time there. The reason for the question about family was because one of the interesting things that we're finding is that a portion of the traders we're interviewing came from families with strong interest in trading. We were wondering if that had a big impact on you or just a marginal one. Did you and Dad talk stocks when you were younger, or was this really your own personal pursuit?
It was mainly me reading the Wall Street Journal, and when he would talk to his friends, I would pay attention.
So after you blew up the account in college, what happened then?
Well, for a while I didn't do all that good. I'd refill the account, blow it up again, but later when I started a company in 1988 or 1989, and I played the options on copper, I turned $2,000 into $40,000 in about 6 months.
How did you find time to trade while you were doing a startup?
Long hours. Plus, I actually used the money to help the company.
So you used your trading profits to help capitalize your startup.
That's right.
That's true entrepreneurial spirit. So you ran $2,000 to $40,000. Did you catch a big trend? What happened in the copper market?
It went up a lot. It went from about 57 to 85, and of course now, copper finally has had its day in the sun. I was very happy with the move because I was buying 70-cent options when copper was at 50 cents and they had a December expiration. I think I bought them in May. It went up a lot.
Author's note: Dana was buying the right to purchase copper at 70 cents a ton when it was only trading at 50 cents per ton. This is a highly speculative strategy that assumes a very large price move over a short period of time.
Was it a one-shot deal where basically you bought options in May and then they just matured into a very fat profit?
That's right. I sold some on the way up, but I made a very, very good profit, 2,000% or so.
Most people typically get out early. What made you hold on to the trade?
Technical analysis. I was following a chart on it and it still looked healthy, and so I held on to it until it started losing momentum.
Were you following the daily chart?
Yes, now I use much finer stuff. But back then, I think that was the only thing available.
Was this trade something fundamentally researched, or was it frankly just luck that you caught a really nice move and then managed to hold on to it? What made you go long copper at that point?
Well, I thought it was undervalued, and then I watched the chart and it dipped down, looked like it washed out, lost its downward momentum. Premiums on options became very small, and so I thought quite a bit about it and got lucky. I've done that a couple times. I bought Boeing at the market turn in 1982. I bought 25 calls. When it was 16 and it went to 28. That was my entire stake in the market. I had very little money at that time, but I made another nice killing on that trade. The stock was selling 4 times the earnings, and it went up to about 28 before the November expiry. Now that I know a lot more about options, I wouldn't have played them that way.
You made a nice punt. Were they trading for teeny 1/16 of a dollar? They must have been very cheap.
I think it was 3/8 or maybe less, maybe an eighth, somewhere in that range, definitely under a half. Actually, I think my percentage on the trade was 3,000%, but I've also been wrong. One time that I was very wrong on the market was in 1998. I read some articles which made a very good case that S&P was way overvalued, so I started buying S&P 500 put options, and I lost a lot of money. I quit fighting the tape the next time. Actually, I nailed it pretty good, which was in late 1999. The market was just absolutely insane, and I was in on the run. At the same point, I was involved with the dot-com startup, and we were being offered just outrageous valuations. So, I actually thought it was going to crash in March or April 2000. I felt that way since January, and I wasn't alone. I think in Forbes magazine, Bob Metcalf of 3Com and Gordon Moore of Moore's Law wrote articles about why they thought the dot-com boom was going to crash. If I had it to do over again, I could probably come up with some options techniques to take advantage of the crash. But back then, I didn't feel like shorting stocks because you never know how far it could run. Also, the option premiums were outrageous then. Now I think I would have done put back spread and things like that, or selling credit spreads, which are good ways to play a runaway market.
Author's note: put back spreads involve selling put options that are close to being in the money, and then using the premium collected to purchase twice or three times as many of far out of the money put options. The strategy works if there is a sharp move down, breaks even if the underlying instrument rallies, and loses money if the instrument declines only slightly.
At that time, you didn't do anything because the premiums were just fat right.
I didn't do much in terms of shorting, so that was a missed opportunity. I could have made a lot of money, and I did make some. But in retrospect, I could have done a lot better because I really felt that what happened was going to happen.
Basically, all the way through 2000, you're very much involved in startups, and we're just doing recreational trading.
Yes, you can say that. It was not full-time. In 1998 and 1999, I had 2 years where I made 50% pretty much back-to-back, and it wasn't actually all that high-tech. I was personally in high-tech myself. In 98 and 99, valuations were so high. I was buying value stocks and avoiding all the overpriced stuff, and at that point that wasn't the best thing to do.
At what time did you say to yourself, I'm going to do this as a full-time trader?
Point 2002 was the time when I really buckled down and saw some very interesting automated trading models and found TradeStation. Actually made a lot of money off their stock too. So it was basically September of 2002 when I really started applying systems and doing it as a full-time job.
Did you develop your own systems, or did you buy other systems and modify them?
I was trading my own systems, but using TradeStation software to do it because you can actually back-test the system.
Why did automated trading attract you? Do you have an engineering mindset?
Yes, I managed software development. Plus, a lot of people say you can never have a completely automated system that will work, but we all know one of the greatest enemies of trading is emotion. People have a tendency to sell at the worst possible moment. I'm no different, but if you back-test something, I think it's just natural for you to do a better job.
So currently most of your trading is systems-driven.
It is, but I don't have it fully automated yet, and I'm working on that now. I can get into positions automatically. I have one system that is very hectic, basically a crash buying system, and so you don't know what stock you're going to be in. Using a list of over 200 stocks. It buys the worst crashes. It can go into many different stocks all at the same time on bad market days, so I have to manage the positions. The system does work, but you feel like you're losing money until you add it all up at the end day and you end up positive.
Is it kind of like trying to crash land a plane?
Yeah, and so I definitely wanted to get that automated.
We're curious about the crash-based system. Clearly, the system searches the market using whatever algorithm you have programmed and puts you in a position. We guess that's done automatically. It simply buys at whatever trigger you have. But once you are in position, you are managing the exits manually. Is that correct?
That is correct, and while you're watching one, another one might be dropping another 2 to 3% on you before you look back over on that screen. So I don't enjoy it. Clearly, it would be better automated. The other thing is you automate the exits, you can back-test them. I have basic rules on how to get out, just haven't been able to get them into the computer. I think that with back-testing, I will find a better way of getting out of position than by watching each stock individually. WealthLab is what I use now. Their back-testing is superb.
The system clearly sounds like it buys dips. Does it also sell rallies?
My back-testing indicates that it doesn't work as well on the short side. When they rip up, they continue to go up, so my back-testing indicates that it is 2 or 3 times better to buy crashes. You're not buying something that's been going down for a week. I'm talking about intraday crashes. It's more of an extreme intraday crash and then picking up hints that the crash is coming to an end. That's proprietary, of course.
Bottom line, you're primary alongside trader in stocks because you found that bias to be much more profitable.
Yes, you have to know yourself, and I do have a long bias. I tend to buy stocks in oversold conditions, and I am not as good at shorting. That's another reason for automated systems. If I can find something that works very well on back testing on the short side, I'll be very happy to do it, but emotionally in my brain, I have a long bias.
When you are in the midst of holding 6, 7, 8 positions, do you have either a mental or an automatic hard stop that serves as your risk control? For example, is it a 5% move down from your entry price, or is everything discretionary at that point?
It tends more toward the discretionary side, but there's also a time stop. I don't want to be in the trade overnight.
So, for example, if at the end of the day you're still negative on the position, do you time stop yourself? Will you get out on the close?
Yes, I don't want to be in too long. I'll give you a valuable piece of advice. The most dangerous stocks are biotech. So I avoid biotech because they can just go down and down and down.
Because it's very hard to gauge value in those stocks, right? They don't have any assets, except whether the drugs either work or don't.
Exactly. They are very emotional stocks.
Generally, you're either going to stop yourself out on time or you're going to hopefully have a net positive move before the end of the day and take profits.
That is correct.
And the system is a day trading system, so you always try to stay flat overnight.
Yes, probably 90% of the time, but sometimes the crash occurs late in day. Those I hold.
Do you find day trading to be more of a function of your own psychology, namely that it helps you sleep at night? Or do you believe that there is actually an edge? In other words, according to your back tests, is it better to day trade?
Yes, I'm just looking for that intraday bounce. I'm not looking to pick up a position.
So it's kind of like a game of hot potato.
Yes, you are buying in effect extreme fear, and then there's a point where that fear tends to bottom out, and then maybe a little optimism comes in, and when that happens, you get out. When you get the opportunity, there are 4 or 5 distinct and different type of behaviors in these crashes. And from experience, you can see them on the charts if you're watching a 1-minute chart. But I consider myself an omnivore trader. I do use many different methods, including some long-term trades like in oil/gas stocks. From 2003 and 2004 until now, I've held positions sometimes for 9 months. So I do some pure value investing, and I throw trading on top of that as I watch the stock a lot and get to know it. I get to see the everyday things. So I might buy in and sell out 5% of the position during the day from these intraday patterns that I've noticed.
How much of a bounce back do you look for? Would you unload the position at 2 to 3% profit?
If keeps having momentum, I'll hold it and watch it, but it's actually less than that. You can imagine how hard it is to follow 4 or 5 stocks in a crash.
Is there a cadre of stocks that you follow whose patterns and fundamentals you know quite well?
Yes, there are about 5 to 7 stocks, and that will change year to year.
And you'll be in and out of those stocks, if not on a daily basis, then certainly once or twice a week based on this kind of a thing.
That is correct. If I really like the stock, I'll hold it. If I just like the technicals, then I'll get in and out. I trade different stocks different ways.
When you buy dips, there's always an enormous danger of a retrace right back to negative territory after the bounce. How do you manage your trades? Do you scale out of half, go to break even? Do you ever allow winners to become losers again?
Sometimes. Of course, that's never the plan, and it depends how far it goes. So if I'm just up a 0.5%, something that's almost down to the noise level, I won't necessarily cash in. I am a pattern trader. I'll watch both the 15-minute chart and 1-minute chart, and I will also watch level 2 and start to get a feel for it. It takes a lot of experience to do this, to get a feel for when the stock is running out of momentum. Once they are quieting down and people get a bit nervous, I basically want to get out immediately at that point. But I do use scaling a lot, both in and out.
Do you use any indicators to help you? Or is just pure observation of price action?
Both. I do believe in a lot of indicators. If you're in a trading range, the stochastics work great. Also RSI. And I follow the moving averages, the 5, 10, 20, and 100. I use that on a daily chart and also use it on a 5-minute chart. To find extreme oversold levels, I have found money flow works the best.
So you use all those diagnostics to help you make your decision.
That is correct, but also experience seeing what works and what doesn't work and developing a feel for it. If the position starts to make you feel uncomfortable, then to me that's an indication that your mind is picking up something that's dangerous.
When you are talking about feel, it sounds like your primary diagnostic is the level 2. You really watch price. You've obviously watched action over and over for thousands of hours.
That's correct.
The moment you see something in the price action that triggers a concern, you liquidate.
That is correct, yeah. And when you mentioned about feel, I can develop a feel for 5 to 7 stocks. But I can't develop a feel for 150 stocks, so that's where you have to have an automated system doing it for you.
When you're doing swing trading, is it also really from pure observation of price flow, or do you look at charts? You have certain technical setups that are relatively orthodox.
Yes, I'd say so. It's double bottoms primarily. I am a little bit of a bottom feeder, but I will get out. I won't stay in if they stay weak. My preference is to have a basket of stocks where the fundamentals are good. There is much less danger for them to continue to crash. One of the things I've found after trading from the long side for any length of time is to avoid stocks that have debt. The worst moves tend to be in stocks that have a lot of debt, with drops of 50 to 75%. Another thing I've found is management is absolutely key.
So it sounds like, on your longer-term trades, you're much more fundamentally oriented. You really want to know the story behind the stock, and you will hold through the day-to-day noise if you believe in the story.
That is correct. In fact, I never hold a position for a long time in a company where I don't like the fundamentals. Now on swing or intraday basis trading, that is pure technical. On the crash system that I told you about, I actually don't even know the companies. Sometimes I have to look up to see what the stock is, never seeing the symbol before. And I do try to read the press release, see how bad the news is, and so forth, and then manage a trade from there on out.
Obviously, biotech was one sector that you would just stay away from, but has there been a time when a stock crashed? You've read the news releases as to what caused the crash, and the news made you say, "You know what? I don't want to touch this. This is just too toxic."
Yes, like if they cooked the books or someone's been arrested. The crashes I like best are when the earnings are good but the stock collapses.
That's a very interesting trade. So you actually like it when you have a positive fundamental surprise, but a negative price movement, and there's a disconnect between the fundamentals and what the price is doing.
Yes, my favorite, because people are just selling out of fear. There's no real reason for it. They say, gee, it should be going up, it's going down, I'm getting out. You know.
There's one unifying theme that tends to run through all of your trading, be it specs and options, or be it swing trading, or even intraday trading. You are most comfortable with a value-based trade. You like to buy value cheap, whether it be on an intraday basis, swing basis, or even speculative basis, and then see it rally.
For long term, that's 100% correct. One such trade I did was in 2003. At that point, we'd had a real crash just like with the 29 crash, very similar, and then I remembered an old Wall Street Week episode. John Templeton was on, and he said when he started out during World War II, he took all the $1 stocks and bought every $1 stock on the stock exchange. So that triggered a memory as we just had a real similar market crash, worst one since 1929. I decided to modify it a little bit to look for companies with no debt. I had 2 criteria, one that it really had to be a good growing company at a good value, or it used to be a decent $20 to $40 stock that crashed to 1. One of my biggest wins was TradeStation, which I bought for 1.02 and ended up selling for $12. Another was AES, a big power company that's used to be $60 a share and was down to $1. I got a 5-bagger out of that. Another one was Dow Corning. It got over 100 and came down to $1, got a 7-bagger out of that. Now it's over 20.
That's fascinating.
Yes, there is nothing better as a trader than to see what you think is going to happen actually happen. The market is humbling to all, though. My best results come after rough periods, where I literally pray to God and ask Him for help and tell Him if things go right. It's not me. The worst results follow periods where I decide I am really good at this and have figured out the markets.
What is your best trade?
That's easy, it was this year. Saw PTSC on a deep value scan, Magis investing formula calm, and loved the huge cash position, no debt and high profits, bought some at 0.08. Near New Year's 2006. It exploded almost immediately, and by March sold the last of it on the high day at 2.10 for a 26-bagger. I wish I had bought more of it.
Let's change tact. You told us the best trade. Now tell us the most painful trade.
Yeah, there's been several. My worst trade in terms of losing money in a short period time was TMR. I ended up walking away from it with a profit, but this gets back to the issue of company management. It was an oil/gas driller down in Louisiana. They had a tremendous new field find and they hit this well. I think it was 33 million cubic feet a day. I already had a position in at $1, and I saw the press release come across the screen and I took a look, and there are still people offering to sell the thing at 2.10. I just bought everything in sight. I ended up at one point with 70,000 shares and it did very well for a while. It actually got up to a high of 9.
You were holding the whole position at 9 still.
Yeah, and I had actually increased along the way and I traded in and out because I got to know the stock and so forth. And then they started missing wells. They had a shareholder meeting in Texas and there were a lot of enthusiastic investors. Then they went from 90% hit rate on wells to a 30 to 40% hit rate on wells. The stock was trading in a channel, and every time it would hit bottom, I would buy and then sell at the top. But it broke the channel at 7.80, I should have just gotten out right then. But in next 3 days lost $150,000, so that's the worst loss I've taken. I did get out for a $150,000 profit, but 3 days before I had a $300,000 profit.
It breaks the channel, and obviously, you make the classic mistake we've all made where you say no. No, it's going back up.
Exactly.
But every single day that it going down, were you saying to yourself, no, it's going to bounce, it's going bounce. What was preventing you from pulling the trigger?
What was going through my mind was, if I sell it now, it's just going to drive it down lower. I was looking for a way to get out. I made a mistake. I had a friend who actually forgot all about it. She had stops and followed my recommendation to get out at 7.78 or something. She lost maybe 10 or 15 cents on the panic spread because it was crashing so hard. She did much better than I did. If I am ever in the same situation again, there are 2 things I would change. 1, I was overconcentrated. I should have not had that big of a position. 2, I knew that there was a problem with management, so I'm never taking a large position in a company where I have questions about management. The 3rd thing, I should have sold at least half of it no matter what was happening. I should have sold it right then and there. I made a mistake on how I handled the trade.
The days that it was dropping, did you go to bed and say to yourself, if it goes below 5, I'm just blowing out of the position. I don't care what price I get. I'm just not going to take any more of this pain. Did it ever come to that point?
Yes, it was just a classical, terrible, emotional trading experience. I'll fill it in with a little human interest story. Sometimes I'd make $40,000 or $50,000 in 1 week on the stock. So one day I said to a buddy, I've always wanted a new Corvette. About a week before this happened, I went out and ordered a new Corvette.
So not only the pressure of the trade, but you had the burden of the Corvette on your shoulders.
That's right, yeah.
You spent money that you didn't quite yet have. Fortunately, of course, the story still ends up very positive for you. After that experience, did you modify your exit strategies? Are you a lot more cautious these days in terms of getting out?
Yes, and became better at not taking concentrated positions.
Let us go back to some general life questions. Are you married? And if you are, how does your spouse react to your trading?
I'm not.
So you don't have anybody to answer to, which makes it a lot easier.
That is correct, and I'm using my own money, and I've actually turned down money. I've had people offer me money several times in the last 2 years, but the thought of losing someone else's money. Having started a business where people invested $500,000, a lot of it from friends, and not being able to return their money for a long time, that was just terrible. So that's why I'm hesitant to take other people's money. I want to be absolutely sure that I can get them a profit. I hate losing my money, but I can handle it. The idea of telling someone else, sorry, the account is down 5% this month, is an extra burden that I don't want.
Do you have multiple trading accounts, or do you concentrate on one?
I have 5, all for different reasons. Cyber trader I like. That's actually what I'm looking at right now on my screen. I have Fidelity because of Wealth Lab. I like Wealth Lab, wonderful back testing. And I have Interactive Brokers because you could trade just about anything there is, and the commissions are wonderful.
When you decided to start trading full-time, you obviously had capital. Did you walk into this venture essentially saying to yourself, oh, I can do this for a full year and not have to make a dime?
Well, no. And if you lose your money, it is a self-correcting problem. It prevents future losses.
But were you capitalized enough to basically not have to draw income off your trading for a while?
No, not really. I was fortunate enough to do very well. I'll give you the actual figures. I had money tied up in other things, but the starting capital I had in December 31, 2002 was $172,000. And I was very blessed because of very good appreciation. I was able to pay all my expenses and multiply the stakes.
That's impressive.
Thank you. There are a lot of horror stories out there, but I was able to succeed. Like my original traditional IRA. I had a very small one. It was like $18,000 as of October 2002, and since then it's grown to $200,000. So I was able to do an 11-bagger on that, and by having it in an IRA, I don't have to go through the tremendous pain of all the accounting.
I can imagine the reconciliation of your trades must be tremendous. It's probably 3,000 to 4,000 trades per year, maybe more, right?
Yes, actually more. I think I average something like 7,000 to 8,000 trades a year, and now that I'm doing options, it's even more complicated. I might have on one trade with 4 or 5 different options on certain stock, so I think my trade numbers are actually going to go up.
When you started trading and you went into trading full-time, did you write a business plan for yourself? And then did you set daily, weekly, monthly earning targets, or was it much more fluid than that?
I did write a business plan but made several changes. For example, I had an automated system in 2002 to 2003, but the results weren't what I was expecting. Then one day I was just walking outside taking a hike. It hit me. I had optimized the system to go from 70% to 130% profit, and as a result it just ended up breaking even.
Author's note: Dana refers to the constant danger of system-based trading, namely the desire to over-optimize your strategy in order to produce more profit. In fact, such tactics often lead to subpar results, as all trading systems typically require very large margins of error.
So it's things like that have happened where I correct my mistakes and write a new business plan. I'm a firm believer in doing that. Another thing I've heard some people say is just look at all your trades. Van Tharp pushes that idea. You can't do that all the time, but I will do that occasionally, and I'll pick up some really big revelations such as a certain type trading is not making me any money at all.
How often do you do that kind of analysis? Once every 3 months.
Yeah, if that, maybe 3 to 6 months. But I suggest to other people to do it once a month.
Do as I say, not as I do.
That's right. Just did it recently and picked up that something I wanted to do for safe trading was actually working much better than I thought. Some other things were masking the profitability of this low-risk system. Just figured that out 3 days ago through a review of trades.
Is there anything else that you could share with us regarding your analysis, or is it proprietary?
It was very proprietary. I can tell you that some of the discretionary stuff I was doing was not working very well, and it was masking what the safe strategy was doing.
So you are coming to the conclusion that the systematic approach is actually the most efficient approach for your type of trading.
I believe that's the case, yes.
Did you have any mentors when you started trading, and, at present, do you have a support group or a group of traders you talk to?
Yes, I do. Starting off, I didn't really know any successful full-time retail traders. It is a fairly rare thing, but I strongly suggest to people to go to Traders Expo. One is out in Las Vegas, and you get to be around all these other people who are full-time traders and get to talk to a lot of top authors. I found that to be a wonderful experience. In the San Francisco area where I used to live, I formed a group of about 4 other traders, and we would talk on Yahoo. Chat and get together every week and have trading sessions together, which I would suggest.
What would that be like?
You have a laptop, someone has an internet connection, and we all have wireless, and then one person would put up a projector on the wall, and we look at the chart and try to decide on a trade and discuss this particular stock. I find that process very valuable. I think everyone gains from it, and on top of that, after the market closes, you share experiences. We watch video tapes together from various authors and so forth.
Can you run us through a typical trading day, especially now that you're in Nevada? Obviously, you start the day quite early.
Sure, I try to get up before the market opens, check some things out. I have a lot of software I have to open up. Then I bring up the charts on the positions that I have. I am actually putting in a better multi-screen setup here now.
How many screens do you look at usually?
Up to now, I've done something people think is pretty wild. I use one screen. A 21-inch-old CRT, but I'm switching over to 3 19-inch flat panels to use with 2 computers. That's an unusual thing about me. I often do 50 trades a day, and I was doing it across one screen, and people say, how do you do that? I do a lot of switching. Wouldn't recommend that to anyone. on the stocks I am most interested in, then check for news. I go use the stock boards on Yahoo. There's a lot of knowledgeable people on some stocks like EGY and CY.
What kind of a news services do you use?
I use Yahoo. It is my main source.
Is most of your trading done in the first 2 to 3 hours of the market, between 6 and 9 a.m. your time?
To an extent. As mentioned to you, I'm doing a lot more option trading where I am looking for specific skews in the market, searching for those all day long. Whatever time they happen, I'll try to enter into some very low-risk trades on that.
When you are talking about arbitraging options, are you looking at discrepancies between the underlying and the option, where you could offset one with the other because there's some skew that you feel you can take advantage of?
Author's note: this is a very sophisticated strategy that tries to exploit momentary mispricing between the option contract and the underlying security. Often options value will be driven unnaturally high or low after a big order sweeps through the market. At that time, a trader can sometimes take advantage of the discrepancy by buying the option contract and offsetting the risk by selling the underlying instrument.
Yes, and now I can also use single stock futures. I'm looking for those types of things, as low risk as possible. If I can make 2% or more per month with no or very low risk, then that's a heck of a deal.
Where did your interest and education in options come from?
I traded options since I was 21, then sort of moved away from them. Part of it was the bid-ask spreads and the big commissions. But now the commissions are almost nothing. They're wonderful, and the bid-ask spreads have gotten better. Plus, sometimes you get fills that are between the spread. Let's say the option is 7.40 to 7.80 bid-ask. You put an order at 7.60 and you wait 5 or 10 minutes, and very often someone will go out and hit it. I found that if you bid with very small lots, then the market makers see them as irritants and will take your bid just to get you out of the way. You put 10 out there and they won't hit it. But if you put 1 or 2 out there, they'll hit it just to get rid of you.
Was there any particular books or seminars that you attended that sharpened your knowledge in options?
Yes, I read Larry McMillan's book and met him at Traders Expo and talked to him. One thing I think is a little bit of a weakness in that book and all option books is they don't really discuss what makes money and what doesn't make money. So I'm doing some software development to prove a strategy, both so I can make money off the software and I'm interested in actually publishing it. Also, I am reading Natenberg now, excellent book, and Thinkorswim free seminars are wonderful, strongly recommend them.
Could you share 1 or 2 strategies that you think do have a high probability of making money in the options market?
Yes, things related to selling nearbys that are going to decay much faster, and then, if you can get a volatility skew on top that in your favor, that helps. Also covered calls on lower-priced stocks with huge volatility. I'm doing that on RMBS now. Diagonal bull and bear spreads have a good chance for a profit.
Author's note: these are various option strategies that essentially try to sell one strike price against another in order to take advantage of the volatility differences between a set of similar options with different strike prices.
Let us wrap this up with a couple of final questions. Where is the drudgery in trading? Do you find anything boring or annoying, or is everything about this discipline really interesting to you?
Good question. Well, I think the worst thing is maybe it's not boring, but the worst thing is losing money and having to deal with paperwork and the taxes is very boring.
How do you deal with losing money? Have you gotten to the point where you can shrug it off, or does it still simmer and burn and you become very annoyed?
I definitely got used to it. I can lose $5,000 or $10,000 in a day and not get affected, but if I lose money 17 out of 20 days, then it still does affect me.
What's been the longest losing streak you can remember? Have you ever had a string of 10 to 12 days where it's just been nothing but bleeding?
Pretty much, yeah, I have. That's the very worst. If it's a slow bleed, it does wear you down. Part of it is that you want to be in tune with the market. Sometimes I just get so in tune with the market, know exactly what it is going to do, and then there are other times when I feel out of tune. I'm out of phase. It's not doing what I expect. What's going on here?
When you're out of tune, what do you do to get your mojo back?
I try and drop back to 40% cash, sometimes even 70% cash. I try to figure out what the reason is. I also think there is a humbling factor that does make you better in the long run. I think the greatest deterrence is that most of us don't think high, consistent returns are possible. You can't achieve something if you don't think it's possible. All you have to do is make 1% a day, that's 200% per year. There are stocks that move around 3% every day, and so it's got to be possible. And because I believe it's possible, then it helps me to get better results.
Last question of the day. What would you say is your number one rule for trading?
I think my number one trading rule is to not worry about being right, just focus on making money and just deal with being wrong. The purpose of trading is not being right, the purpose is to make money, and I think that's my number one rule. Don't get hung up on your current positions.
Lessons from Dana Allen. Look for 10 baggers. One of the most impressive aspects of Dana Allen's trading is the amount of trades in his career that have returned him more than 10 times his initial investment, or as he calls them, 10 baggers. Whether in options, stocks, or commodities, Dana has been able to achieve these incredible results by always buying value. Using John Templeton's maxim that investors get the best bargains when the world seems to be coming to an end, Dana has been able to pick up bargains at severely distressed levels more than once during his trading career. In fact, using the same method that Templeton employed half a century before him, Dana bought as many $1 stocks on the NYSE and NASDAQ as he could find, following the 2001 market crash, a strategy that proved to be extremely profitable in the ensuing market recovery. One critical rule that Dana always follows is to only buy securities of companies that have no debt. This is a very wise approach because debt-ridden companies can collapse even if their underlying business remains relatively sound, especially if they are forced to divert their cash flow to service debt. Stocks have an upside bias. Over the past 2 centuries, stocks in the United States have returned an average of 7%. Massive stock corrections notwithstanding, equities are the only financial asset that show an unequivocal uptrend on a longer time frame. Therefore, selling rallies works less well in the stock market than buying dips. Stocks have a natural upside bias as they tend to appreciate with the expanding economy. Many market analysts refer to this phenomenon as the upward drift. Certainly, stocks can fall mercilessly for days, weeks, and even years on end. Over the long term, however, they tend to rise rather than fall. As a wise man once said, the race does not always go to the strongest and the swiftest, but that is the way to bet. And that is the way that Dana Allen generally bets, preferring to buy crashes rather than sell manias. Stops should use time as well as price. One very interesting part of Dana's methodology is the use of a time stop as well as price stop. After all, trades travel through both time and price, yet traders only focus on the price part of the risk. Dana uses a simple end-of-the-day stop on his crash buying system. If the price hasn't reached his objective by end of the day, he terminates the trade even if it remains above his stop. The basic premise of his setup is that prices should quickly bounce off their depressed crash levels as bargain hunters swoop in. If the bounce hasn't materialized, that may mean that the majority of the market does not perceive value at these levels, and further declines may be in store. Therefore, a time stop as well as price stop would help traders to minimize risk. Best trade setup is a disconnect between fundamentals and price. Divergence is one of the most common setups in trading. Typically, divergence is traded off technical factors when momentum indicators disagree with price action. However, Dana Allen likes to trade divergence based on fundamental reasons. One of his favorite trade setups occurs when a company reports superior earnings, but the stock sells off on profit-taking. This is a very interesting strategy because once again, Allen positions himself on the side of value. Once the wave of initial profit-taking crests and the selling is completed, the same stock can often present a compelling value as long-term investors buoyed by strong fundamentals return to the bid. The one exception to this setup is the biotech sector. Dana feels that financial value of biotech stocks is extremely difficult to gauge, given the fact most of these companies live or die by the actions of the FDA's Center for Drug Evaluation and Research, and have no assets aside from their intellectual property. Chapter 3, The 100-Pip Trader, Rob Booker. Even though Rob Booker is a former lawyer turned full-time trader, if you asked him to describe his job, he would tell you that he is a back tester first and a trader second. In less than 5 years, he has gone from being a $2,500 trader to a client of a major bank who trades a respectable size account. He practices defensive trading and focuses on preservation of capital. His number one rule of trading is, if I can't prove that a system works from my testing, then I have no business trading it with real money. A fan of the casual attire lifestyle, His humorous, laid-back approach has built him a huge following. He's one of the funniest traders that we know, as well as one of the most humble. He has taught over 1,000 traders how to trade, and all of them call him their friend, as he strives to maintain a lifetime relationship with each one of them. From his office in Wheeling, West Virginia, Rob took a few hours to talk to us about his approach to the market and to share some of his tricks of the trade. Can you tell us a little bit about your background in the financial markets? Were you exposed to the concept of finance as a kid, or was it much later?
If I had any experience in anything related to stocks or investments when I was young, it was probably somewhat negative. It's not that I was discouraged from being involved in the markets, but I was always encouraged to think of what I would call more traditional occupations, law or medicine. I don't know enough math to save my life, and I always heard that to work in the markets, I would need to have a strong math background. So Wall Street wouldn't have been much of an option in my mind anyway. Honestly, I was never encouraged to think about working in the markets, so I guess you wouldn't call it discouragement, but it never arose as an option, as a career, or even as a hobby, and it wasn't even something I was remotely interested in. The earliest that I can remember being interested in investing at all was when I took a course in high school as a freshman, and it was a business course. We were expected to buy stocks at the beginning of the semester with a play account, and then track the quotes in the newspaper for the semester and see how it turned out.
Did that whet your appetite in the financial markets enough to keep you interested?
No, I think I took the class and forgot about it, but I really enjoyed taking the class. I remember I bought Pioneer stock. It was the company that made electronics, and I really wanted a Pioneer stereo with a CD player at the time. So I decided that I would pick a stock based on something that I liked, and I am fairly certain I came in last. So much for investing in something just because I liked it, and not because it had true upside potential. Yet during that semester of high school, I was entranced by the thought that you could actually buy a piece of a company or invest in something, and then basically play the game of waiting to see if you had made the right decision. I was seriously interested in it at the time, and then I just forgot about it. In fact, I completely forgot about it until much later on.
That's very interesting, because not everyone who is successful at trading actually majored in anything remotely related to it in college.
Yes, exactly, and I never actually took any economics classes in college at all. The big scary class at BYU Brigham Young University when I was an undergraduate was Economics 101, and it seemed so daunting from all the horror stories I heard about it. So, although I was interested in business, and by that time, I was once again interested in the markets, I was just too fearful at the time to really take the plunge and study economics in college. I missed the opportunity to get a really good foundation, which I think would have assisted me later on in my trading career.
So then, you went on to study law.
That is correct. As soon as I graduated from BYU with a degree in Italian, my wife and I moved to San Francisco, where I started law school.
Was that because of parental pressure?
Mostly, yes. I think it's unfair to blame the decision on my parents, but in my mind, I really did enroll in law school because I believed, from my upbringing, that it was the safe route. That's exactly the reason why I went. I think I was strongly encouraged by my parents to pursue a traditional occupation that would allow or enable me to support my family. And any pressure I felt from my parents was positive. They were excited for me to go to law school and told me that they believed I would do very well. They were probably more excited than I was about law school. It was never forced on me, and I sort of followed that path because I had come to the conclusion that that's what I wanted to do, and I had a vision of a legal career that was quite different than what's practically possible as an attorney. It did not take long for me in law school to realize that I would have no interest in practicing law.
What kind of law were you studying?
Well, in law school, it's just so general that at the beginning you don't get a lot of chances to specialize in anything. So I took courses ranging from criminal to constitutional to business law. When I was in law school, I took a summer job at an investment bank in San Francisco, and my wife worked for a hedge fund. The exposure to these jobs started me thinking again about a career in the markets. So I started picking courses in transactional law or corporate law, and found that I was once again fascinated by the idea of trading and realized that I had caught the bug a long time ago and I just couldn't shake it, and I kept coming back to the same thing. One day while working at the investment bank, I met a trader. Later on that same day, someone told me that the trader I'd met made $600,000 the year before. That seemed to me to be way more money than I could make practicing law. Then, I was told that this trader would probably make over $1 million in the current year. I started wondering what the heck I was doing in law school.
That's really interesting that you took an internship at an investment bank, because people who study law usually take internships in some of the big law firms. What made you take it?
That's a good question. It's very kind of you to even ask that question, that you would assume that a big law firm would have had any interest in me, which they did not. I made the decision to work at an investment bank mainly because I didn't have an alternative available to me. Although I was fortunate to get into a good law school, my grades were absolutely terrible. I was uninterested in a legal career from nearly the very beginning, and my grades seriously reflected that lack of interest. So I took a job where I could get one, and the place I could get a job was as a lowly staff assistant type position at Montgomery Securities in San Francisco, and I absolutely loved the environment. I was actually working at Montgomery Securities on the day they helped take Netscape public. Everybody in the office, especially in the operations department, was fascinated by the idea that this company with no revenues could be taken public. I remember people telling me that this new company was doomed to failure, and there was no way it could ever survive. Well, we know now that the founders of the company were made very rich, and that the company was sold to AOL in 1998 for $4 billion. The day Netscape went public, we watched as the stock kept going up, and everybody made predictions as to how far back down it would go. But it really never did go down for as long as I was there. And I think that was one of my formative experiences, where I realized that the markets were an amazing vehicle for wealth creation, and they made people wealthy very quickly. Maybe that's not a great lesson, but it certainly was one of the things that attracted me to the markets once again. And I never lost interest for longer than a day after that.
Did you ever finish your law degree, or did you switch careers before that?
I did finish law school. I could honestly say that there are very few regrets in my life, but one of those would be that I did not take a job as a trading assistant at Montgomery Securities, but rather continued my legal studies and went all the way through and finished law school.
When did you decide to switch careers?
Once again, my not-so-fantastic grades in law school threw me an opportunity to look elsewhere. I had job offers after law school to work in law firms, and what I realized at that point was that it just simply wasn't going to work for me. So I attempted to enroll in a PhD program on the East Coast. My wife and I moved to the East Coast, and when I decided that the PhD program wasn't for me, I actually worked at several jobs, whatever I could do to earn money and support my family. Anything to avoid law. I was happier making 1/3 the amount of money in other jobs. Once again, the markets came back up, and within just a couple of years, I had been introduced to a private currency trader in Southern California. That's when I really sort of realized that I didn't need to work in an investment bank to be involved in the markets. I didn't need to have a business degree. I didn't need to have a lot of special connections. What I really needed was a good internet connection and some information on how to get started and the perseverance to make it through the bad times, the hard lessons that we all seem to go through. So that was the beginning of my currency trading career.
It seems like your wife at the time was extremely supportive, or at least very flexible to be moving around with you.
Well, she's never been the type of person who would encourage me to do something that wouldn't make me happy, and money was never our first concern as a married couple. The first concern was quality of life, and whether we are doing things with our time on earth that allows us to spend time together and allows us to feel comfortable and good about what we're doing. As long as I was moving forward in those plans, money wasn't going to be a problem. Because of this, I'm very familiar with the dilemma that a new trader has in attempting to work a full-time job and try to trade at the same time. We were deeply in debt after law school. I defaulted on student loans to pursue currency trading as a career. We experienced enormous financial pressures, including the inability to pay our rent, or make our car payment, or really have enough money for basic essentials. But we decided that was the direction that we were going to go, and once I made that decision, I wasn't going to give up. I didn't have any special training or a trading account funded by parents. This was something that we had to do from scratch.
So you started immediately in FX, in Forex, or did you first dabble in futures or stocks or something else?
I've never made an equity trade in my life, except in 9th grade when I bought Pioneer stock, and it went down at least 10 points by the end of the semester.
Tell us about this trader from Southern California. How did he get you involved in the markets?
I was introduced to the trader in Southern California through a friend of mine who had been very successful in business. My friend said, "You know, if you're interested in trading, you should talk to this guy who's trading my money." At the time, my friend said that he loaned this currency trader in Southern California approximately $1 million, and this currency trader was paying my friend between 6 and 8% per month in interest. I thought, well, here's something. This trader is amazing. He must be throwing off enough gains to produce that 6% in interest monthly and still have enough profit left over. In fact, my friend at the time had received back the entire amount of his principal over the course of about 12 months, and now was receiving basically interest payments. So I thought, if somebody is so successful at currency trading that they can do that type of thing, that they can borrow money at ridiculous interest rates, then that's something I want to learn about. One thing led to another, and this currency trader introduced me to his methodologies, which seemed too good to be true. You know what they say about that. We discovered later on was that he was raising money and making payments to the people who had given him money in the first place by raising more money on the side. Eventually, that game caught up with him. By the time I found out that he wasn't for real, I had already sort of lost my first account and had decided that I could figure it out myself if I spent the time necessary to do so.
It must have been pretty scary to be in such a financial strain and then not to trade well when you first started. How did you find the confidence to keep on doing it?
I wasn't very good at practicing law when I first started, or doing much of anything else that I first started in life, and I always approached things from that perspective. I mean, on the first day that I drove a car when I was 15 years old, I wasn't very good at driving, but over the course of time I became comfortable and successful at driving, and that didn't happen overnight. I understood that there were going to be some losses, and so the financial pressure came for the reasons that you feel financial pressure. Meaning if you get an eviction notice, or if you can't make your car payment, you naturally feel pressure. But I don't think I felt pressure to figure out trading immediately. I think I'd met enough traders in San Francisco and spoken to enough people who helped me realize that this was not going to be any different than playing sports or having a first job or learning to drive. There was going to be a learning period during which I felt uncomfortable, made a lot of mistakes, and had to learn for myself some of the things that you simply can't learn by reading a book or listening to someone else as much as they try to help you.
Did you make a lot of mistakes in the beginning?
Oh, certainly yes. You have a page limit for the book. I made every mistake that you can possibly think of. Here's the basic list. 1. I made too many trades. 2. I traded with lot sizes that were way too big. I was risking 5 to 10% of my account on each trade when I should have been risking less than 1%. 3. I traded multiple systems at the same time. 4. I traded any currency pair that I liked. 5. I traded at all times of the day. 6. I traded long-term and short-term. 7. I read way too many books about systems and far too few books about discipline.
Did you take any classes?
No, I did read a lot of books, but I never took any classes. I think the best book I read at the early stages was Reminiscences of a Stock Operator, which most people know to be the not-so-secret biography of Jesse Livermore. I also found a lot of wisdom in biographies of successful people, including John Rockefeller, Gandhi, George Washington, and other founding fathers. In many cases, I found more trading wisdom in the biographies than in the trading books.
How long did it take you to get it right?
11 months. During that time, I tested my brains out. I built my own trading systems and tested them endlessly. I tested for hours and hours every day. I traded with a demo account and a small Lien account.
Did you at any point feel like giving up?
Probably every day laughter. I probably felt that way on a regular basis at the beginning, and some of it was because I was also working at the time. I would develop websites. I took a job selling T1 lines or internet service at the very infancy of the internet. I took a job as financial recruiter, a headhunter. The one thing that I would not consider doing was taking a job working in a law firm, and that was simply because I didn't want to get sucked into the lifestyle and go down a path that I felt really uncomfortable with for the long term. So I did a lot of things on the side, and as much as I could just to make sure we could stay afloat during the time that I tried to learn how to trade.
So you worked full-time while you were trading? Or was it more like part-time?
I'm absolutely positive that I worked full-time hours, and some of those hours were the 9 to 5 type, while some were side projects where I did consulting work like write a contract or help with a website. I looked for whatever work I could find that I would be able to do in the middle of the night ideally.
So how did you manage to trade while working full-time?
I just didn't get a lot of sleep. The only answer I can come up with, looking back on it now, is that I woke up at 2 or 3 o'clock in the morning and I would watch the London or European sessions. The reason I did that was because I had been first introduced to currency trading from someone who was taking trades in the middle of the night and trading during those sessions, so that's the session that I was drawn to. And so I would get up really early and then by the morning I would be ready to work or do whatever else it was that I was doing to earn actual money, and then I would come home and I would try to sleep and spend time with my wife and get up early again. So I literally made it work by just getting very little sleep.
Do you think that was the key, that you felt like you had to make this work?
Yes, I made a decision one time like I do with most things. I made a decision that I was going to make it work. It was clear to me that other people could trade for a living, and if it was possible for other people to do it, then I could persevere long enough to figure it out. I knew it might take me longer than someone else, but I wasn't in competition with someone to do it faster. I knew that I wouldn't have a large account like someone else might have, but I wasn't in competition to have a certain size account. I was just trying to figure it out so I could be consistently profitable. I also had a very good friend who was a financial planner, who told me that the secret was to grind out regular profits on a regular basis. The goal wasn't to hit the jackpot or pull the slot machine or win the lottery. The goal was to consistently grind out profits week after week. And if I could be profitable each week, the amounts that I made wouldn't matter, as it would prove that I was able to keep what I had earned. And I think I just decided that was the main focus. If it was just $50 a week, or it was even just $25 a week. At the beginning, the amounts were irrelevant, and really figuring it out was more relevant. Then, later on, I figured I could find more money to trade with if I had to. I can't emphasize this enough. The big lesson for me here was that I didn't have to make $1,000 per day or even per month. I just needed to make something and not give it back. I learned that if I took care of my trading capital, the rest would take care of itself.
How much did you start trading with?
$2,500. It was partially mine and partially an investment that a good friend made in me. In the first few days of trading, I made 10% in the account. I should have closed the trading software down and not opened it up again for a month.
What happened?
I almost remember it exactly. The account went from $2,500 to about $2,752 and some change, and I had a 10% gain in the account, and I should have shut it off and walked away for at least a week. I was positively euphoric. I was the Warren Buffett of currency trading. I remember I had heard these stories about guys returning 6 to 8% a month or more, and I figured I could just continue to do something like that. But I didn't stop. 2 weeks later, I took a trade, placed no stop loss, and 72 hours later I had lost 90% of my capital. I remember drawing it down to the point where it was at $2,500 and saying to myself, maybe I can get out at break-even, and it will be like the bad trade never happened. Then it was down $2,000, and then it was $1,500, and by the time it got down to that level, I just thought it can't get any worse, so I just might as well just leave it open. And of course, it would get worse.
So what do you do differently now?
I try my hardest to not lose money. That's my first concern. I know this sounds heretical, but making the money isn't the hard part. When I first started trading, I was in a very bad spot financially. A close friend who had been very successful in business took me aside, looked me in the eye and said, "Rob, you've convinced yourself that making money is difficult." Then he said, "Making money is easy, keeping it is difficult." He wasn't speaking about trading, but he could have been, and he was right. I have found that it's not terribly difficult to develop a profitable trading system. What requires real grit is the ability to hold onto the profits, to not overtrade, or increase the size of the trades beyond what is an acceptable risk. So the name of the game for me has been to not lose money first, and then just grind out profits week after week as a second goal.
How long did it take you to figure out that you needed to trade defensively?
It was 11 months into my trading that I really started practicing this. After losing that $2,500, I spent 11 months testing and experimenting and reading not just about trading systems or methodologies. I tried to learn and adopt the principles that would guide me from a mental standpoint from then on. I was determined to never fall into a trance on a losing trade, what I call possum trading, where you sort of fall asleep and act like if you don't watch it, it will all get better. I promised that I would never let that happen again. That was the big goal, and it took 11 months not just to figure out entries and exits, but really get to the point where I could trade on a practice account consistently enough that I wasn't gambling with the account any longer. And so the central goal became to never lose the starting capital. If I could keep my capital, I could stay in the game. Trading is a game of survivability.
What was the process like in terms of teaching yourself? Did you teach yourself basic chart reading, or did you learn about fundamentals first?
I exclusively started with technical analysis. Economics intimidated me, so I at first avoided fundamental analysis. Instead of reading about economics, I took a copy of Alexander Elder's Trading for a Living, and I read about moving averages. During that 11-month stretch of time, I literally sat at the charts and back-tested and experimented exclusively with moving averages. At the end of 11 months, I actually remember somebody asking me if I'd chosen one of my moving averages as the 62 moving average because it was fib ratio, and I asked them. I didn't understand what the word fib meant. I hadn't actually done much other analysis except for my own testing and experimentation with moving averages. I would plot moving averages on the charts. I would move forward one candle at a time. I would experiment with different time frames, different currency pairs, until I had accumulated just an enormous amount of research of my own in how price interacted with those moving averages and what I could expect from a given type of trade. I wanted to be able to open a trade and answer the questions. What could I expect to lose? What could I expect to win? And when those win/loss ratios became acceptable, and I could trade the strategy consistently week after week after week, profitably, then I knew I was defending my account. I knew that I was consistently grinding out some profits week after week and trading with a system that might not have been perfect, but certainly produced gains on a regular basis.
So the way you essentially back-tested is to go back into the price charts and look for examples of what you thought was going to happen, right?
Yes.
You didn't use some sort of programming language to mechanically back-test.
Right. That's the other part about it. At a number of levels, I was really too uneducated or stupid to know at the time that you could even program anything like that. I wasn't even aware that there was some type of programming language or charting platform that would allow me to back-test that stuff automatically or mechanically. Now I'm happy I didn't have any of those tools because I gained a lot by watching the charts and not doing it in such a mechanical way. I became familiar with the way that price moved on the chart for the British pound/US dollar. I got familiar with the US dollar/Japanese yen. I became accustomed to looking at the price move up and down in regular, repeatable patterns. I seared into my memory the trends, the ranges, and just a few currency pairs became familiar like friends.
Do you think that's still the way you primarily back-test at the moment? Because we're sure there are a lot of new traders who find things like easy language very, very daunting in the beginning.
I say this to everyone now, and I've been saying it most recently in the following terms. I have a career as a back tester. Then, on the side, I have a part-time job, and that's being a trader. So yeah, I still engage in that process of testing every day. In fact, before we had the phone call today, I've been working with another set of moving averages on another time frame chart together with people who have come out to my office to have a back-testing fiesta, as I like to call it. My entire office is organized so that groups of people can enthusiastically engage in the process of testing together.
So no one in the office knows easy language or any other programming language.
I actually now know easy language well enough to program most of what I do. And additionally, I work with at least 2 different programmers if I needed to help optimize mechanical systems if I chose to do so. But it's very seldom that I'll optimize something or program it until I actually have already proven that it works just the way it is. So I might program it or optimize it in order to facilitate the process of sounding off alarms or alerting me to the opportunities. But I still don't engage in any type of mechanical trading whatsoever, meaning I never let the computer make the entries and the exits.
So you back test more for reference and to create a foundation.
Yes, absolutely. It's a scientific process, hypothesis, the ideas for a trading system, then experimentation, then results, and so forth. If I can't verify it, I won't trade it. If you and I plotted a random indicator on price charts on any time frame on any currency pair with at least 5,000 to 10,000 bars of data, and locked ourselves in a room for 6 months, we could build a system from that one indicator. It's all about verification and experimentation for me. I have no actual preference for one type of methodology, whether it be fundamental analysis, price action analysis, order flow analysis, support and resistance trading, or astrology. As long as it can be verified historically, I'll take that preponderance of evidence and say at least it shows a statistical advantage historically. And although past results are not indicative of future performance exactly, they certainly provide a lot of evidence to support some methodology that I'm considering. And if we don't have any statistical basis for what we're trading, then we're just taking the random walk down Wall Street, as they say, and what good is random trading?
How far back do you usually test?
Well, when I did short-term trading, which is any time frame below 1 hour, I generally don't go back any further than the advent of the euro, meaning I'm trying to take advantage of a current market. I want to actually experiment with the market in a similar way back than as it is to now. So I do not want to experiment with the 15-minute charts in a time where the Deutsche Mark and the Italian lira and the Spanish pesetas were all basically floating and affecting volume. I won't do anything short-term any further back than 2000-2001. If I'm experimenting with the daily charts or something longer term, I'm more willing to go back into the mid to late 1990s. But if I go back too far, I'm going to go back to a time when currency trading was all done with the good old boys club, and they were all using rotary phones. It feels uncomfortable to me to go back any further than that.
Yes, the market was traded very differently back then.
Exactly. Traders were writing down their orders, and the British pound/US dollar currency pair would have 1-hour candles that were 100 pips large each time. It doesn't make as much sense to me to expect the market to be similar then as it is now.
In the beginning, we talked about how you focus primarily on technical analysis. However, over the past few years, have you incorporated any aspect of news in your trading?
On a weekly basis, I actually draft what I call crib sheets, or cheat sheets about economic fundamentals. And I'll take an 8.5 by 11 sheet of paper, and I'll write out major economic statistics from around the world. I accumulate that information using free resources on the internet or paid resources like Bloomberg, and I keep a regular accounting of statistics from all over the world. And I laminate those cheat sheets, and I actually take them in with me into the shower in the morning, and I'll just put them against the wall. And because they're laminated, they stick against the wall, and I just memorize and track economic statistics from around the world. So that when I'm taking longer-term trades, for instance, trades that are going to last from a day to as much as 1, 2, or 3 weeks, I understand the underlying economic fundamentals. For instance, I might understand that inflation and wage increases are still really strong in Australia, which might lead the Australian Central Bank to either increase or keep their high base interest rate. I might understand that at the same time, Japan has an economy that is finally coming out of a deflationary period, and that interest rates are possibly going to rise over the next 18 months. I might understand simultaneously that economic data coming out from the US shows that the Federal Reserve is likely to pause on interest rates and then go into a cycle of loosening monetary policy. If I understand those background economic fundamentals, it gives me a little bit more information on why I'm taking the longer-term trades that I'm picking. I generally never take a longer-term trade or a shorter-term trade solely based on any type of economic fundamentals, meaning it won't be the reason I picked the trade. But it could factor into how long I stay in the trade. It could factor into whether I feel more confident or less confident in a trade. Oil is a perfect example. I track oil and I watch the Canadian dollar and its response to oil prices. So I may use fundamental analysis as part of the picture, but I never exclusively use fundamental analysis to make a decision about a trade.
Now, would you ever use fundamental analysis as a reason to not get into the trade?
I'd use it to some degree. For example, I might not short the British pound against the Japanese yen for any extended length of time, knowing that an interest rate differential is going to create some sort of significant transaction cost to hold a short British pound/Japanese yen trade for anything longer than a few days. So I might be more reluctant to hold something longer, and I might be reluctant to even initiate that type of position in the first place, knowing those type of things about fundamentals. Although I have in the past made short-term trades immediately following major economic events, such as the non-farm payrolls report, it has been quite some time now since I have done it. I think that it is absolutely far more dangerous than it ever used to be. Far easier to lose a significant amount of money, and it has become, on the retail investing side, something of a scheme or a trick that people want to teach other people to try and do. That becomes a really quick way to lose a lot of money. It's sort of a get-rich-quick lottery or slot machine type mentality, so I will rarely participate in any short-term moves around economic events. I'll usually let the market settle down, and I'll just buy or sell depending upon how it fits into the bigger picture.
It's interesting that you talk about interest rates or carry. You ever factor it into your shorter-term trades or just longer-term ones?
Into my longer-term traders, absolutely. My good friend and trading partner, Maxwell Fox, and I did a long-term interest rate study that tracked the interest rates, the monthly average or the monthly base rate for the Bank of England, the Bank of Canada, the New Zealand Reserve Bank, the Bank of Japan, the U.S. Federal Reserve, and the Swiss Central Bank, and we plotted rate differentials from the early 70s. I can't remember the exact year, but it was 1974 or 1976, all the way through to the present. And then we tracked the average monthly spot price for each of the currency pairs that would be affected individually. What we generally found was that spot prices lag interest rate movements quite a bit. For example, in August 1990, differential between the pound and the yen interest rate peaked at about 10.5%, meaning that the Bank of England has an astoundingly higher interest rate than the Bank of Japan. I believe the Bank of England had a base rate at 15%, and the Bank of Japan had a base rate of something like 4%, and what we found was even after that differential started to come down to 10%. The spot price continued to rise afterwards, meaning it took a while for those carry trades to actually unwind. There wasn't as quick of a process of unwinding. It didn't turn on dime. Actually, spot prices took a while to catch up. So, returning to your question, in my longer-term trading analysis, I might take into account the fact that although interest differentials are converging or diverging, it takes the spot price a while to catch up with some of that interest rate movement. But it does, in fact, historically tend to catch up with the interest rate differential. So if there's any primary long-term fundamental tool that I use in forecasting currency movements, it's definitely interest rate differentials from nation to nation.
How many hours a day do you spend trading?
3 to 6 hours per day, which includes the planning of trades and analysis, and so forth. The rest of the time I write, answer email, and spend time with my family or my other community responsibilities.
What is your typical day like?
If you look at my day from a 24-hour perspective, it goes something like this. I go into the office at about 7:00 a.m. Eastern Time, and I trade the short-term New York session if a setup comes along, and if I haven't already reached my profit goal for the week. I answer emails and keep an eye on long-term charts at the same time. I also chat on instant messaging with some of the best traders that I know. By 12 noon, I'm done with the short-term trading, and I move on to producing content for my website and planning long-term trades. In the afternoon, I try as often as possible to also go back home and spend time with my family, wrestle with my son, or play with my baby daughter, and help out around the house. In the evenings, I do more long-term analysis, read with my wife and kids, help put the kids to bed, and then do more long-term analysis. I don't often get up in the middle of the night any longer, but when I do, that is a perfect time to check on some of the longer-term trading.
What is your goal for the week?
I have a point target in my trading account, a goal for a number of points of profit or pips that I want to make per week. But I don't have a dollar-based earnings target. I find that thinking too much about a certain dollar amount or an item that I want to buy takes my focus off what the market is able to give me and puts the emphasis dangerously upon what I want the market to give me. I've pretty much consistently decided that Rob Booker is a 50 to 100 pip a week trader, meaning I understand the limits of my trading capacity, and over 50 to 100 points of profit. I start getting a little bit crazy. I become a little bit less disciplined and a little bit more euphoric, to put it mildly. So I have not generally done a lot to increase that PIP target over time, even though systems that I build might produce bigger gains. This is actually something that I strongly believe in. There are two things that I haven't mentioned so far that I feel are really important, and one of them is that there is a misconception that, in order to be considered successful as a trader, one has to earn a certain dollar amount per week, or per month, or per day. One thing that I've tried to communicate to beginning traders is to never be concerned with comparing your own PIP results, or percentage results, or dollar results to anyone else except for yourself. I'm not in competition to make more money than Joe Trader. I'm in competition to make sure that I make enough money to support my family. So I've been to expos and conferences, and I've spoken around the world, and traders who are new to trading will say, "Well, Rob, how many pips did you make last year or this month?" And I'll discuss it with them, and they'll say, "Well, that is far less than Joe Trader, or so and so making." And I will tell them all the time, "Well, I wasn't aware that Joe Trader was trying to pay my bills. I wasn't aware that I was under some demand to compete with anyone else. That's really important for me and has been a real benefit to me in the long run. Just to remember that I'm not in competition with anybody else for a certain type of gain." So no, the answer is I have not generally increased that goal, and when I have increased that PIP goal, I found that I become somewhat overconfident after a series of wins or too despondent after a series of losses. What I do when I trade for 50 to 100 pips a week is, if I have a good week, then the next week after, I start it all over again. I reset the clock. I reset the PIP count to 0, and if I have a bad week the next week, when I start back up, it's a blank slate. It's a 50 to 100 PIP week. I don't have to make back what I lost the week before. I just have to produce what I know statistically I can produce, not what I have to produce in order to make up for a previous loss or prove that I'm better than someone else. I just have to take advantage of whatever comes my way during the week to reach that goal.
That's a good point. So you don't increase your positions the next week to cover losses that you may have made the prior week.
No, and that's always been troublesome for me. And when I have done that, it's certainly where I've gotten into the deepest pit, which is when I've had a really good week and I've thought the market's just going to shower me with sweet profit forevermore, and I will never see another losing week. Well, usually that's right after the market's ranging in exactly the way I like, and then it's going to break out into a trend the week after and just savagely beat me to a pulp. So I try to say, never trade the last trade, only trade the opportunity that is in front of me. Once I reach my weekly goal, I either stop trading or reduce the size of the trade so far that I can't possibly do any damage to my account. The overarching goal for me is to protect the account. Then all I have to do after that is make money every week and build the account bit by bit. The most amazing financial discovery in the history of humankind is the principle of compounded gains. I tell this to every new trader: if you can build your account bit by bit, you will realize spectacular profits over the long run, even if it doesn't look like much in the short term. I might be overemphasizing this point, but it has been important for me to remember that making money as a trader means that I grind out regular profits over and over again and focus on consistency, not on the big score or a huge lottery-type payoff.
Let's talk a little bit about your trading tactics. You typically make your first trade more of a probative trade, or do you go all into the position?
It depends on which trading system I'm going to be employing. If I'm taking a short-term trade based on the 15-minute chart in the New York session, which I call a New York session box trade, I'm all in on the first trade and all out at the exit point, meaning that it's a point-to-point B trade. It's not based on a news event. It's not based on a spike that's created by any fundamental analysis necessarily. But it's basically a support and resistance system that triggers an entry and triggers an exit that is very well defined, and I'm all in from the start. On my long-term trading, I am much more likely to initiate a position with between 30% and 50% of my total available position size for that trade, and then add to the position as it goes in my favor and is proving to be the right decision. I prefer not to add to losing positions or cost average. That has never worked for me personally.
What time frame charts do you look at?
My favorite time frame chart is the 1-hour chart. That's where it all happens for me. In the past, I've extensively used the 15-minute chart and others, but right now my main focus is on the 1 hour. I often take positions on the 1-hour chart and hold them for a day or longer. I regularly hold these positions overnight, and because I've got a defined risk and a specific profit target, I can just let the trade go without my attention. Like most traders, I check on my trades regularly and somewhat compulsively, but I generally try my best to let them run their course.
So you basically range, trade more in the short term and trend, trade more in the long term then.
Well, it is exactly the opposite. Historically, I look for breakouts into trends on the short-term charts, and in the long term, I have been far more successful trading the corrective patterns in ranging markets.
So how many positions do you generally have at the same time?
When I first started trading, I would have a whole basket of positions open at the same time. I might have 6 or 7 positions based on a similar system on a similar time frame chart across a variety of currency pairs. So I might take a position on the British pound/US dollar and then simultaneously take a position, for instance, in the euro/Canadian dollar. Although I wouldn't necessarily be trading the same currency pair, and they wouldn't be very correlated, the same fundamental principles would be used to initiate the trade, affording only a minor bit of currency pair diversification. But as I became more familiar with the currency pairs, I preferred one over the other. It is far more likely that I would actually trade one currency pair that I felt most comfortable with and maybe on occasion initiate a total of 2 or 3 separate positions at any given time.
So basically, a total of maybe 3 positions, no more than that at any time.
Right.
Do you ever average down?
I am not a proponent of adding to a losing position, and recently I took a 6% loss on one account I manage because I averaged down against my own rules and then could not, per my money management guidelines, add enough later on. So I exited the position at the maximum loss I allow myself to take, and boom. The trade turned just a bit later on. Whenever I break my rules, I get burned. I prefer instead to add to winning positions, and those have been my big winners. When I'm on the way to a profit target that I have tested to be better than 80% accurate, there are stages along the way where it makes sense for me to capitalize on the good decision. It's not enough for me to always just let it run the course to profit. I want to maximize to the full extent the possible profit because my equity is growing as the trade is profitable. I can add positions and still keep my risk low. I like to use the analogy of a relationship. If you are in a terrible relationship and you can see that it's not working out the way that you wanted to, you should end the relationship. We've all been in relationships we should have ended more quickly. Trading is the same. If I'm in a position that is not doing what I expected it to do, I don't need to last it out or put more time and effort into it. I get out and move on. Conversely, if I am in a good relationship, I want to nurture it and let it grow. That's like a winning trade. You want to watch it grow, not cut it off. People who take half their profit off from a winning position are doing, in my opinion, the same thing as walking out on a perfectly good relationship.
Are there any currency pairs that you avoid trading, and any currency pairs that you love to trade?
One of my favorite currency pairs to trade in the short term, meaning the New York session in particular, during hours that I'm actually awake when the market is moving, is the euro to the Canadian dollar, EUR/CAD. That's one of my all-time favorite currency pairs in the short term. I also have a huge preference in the short term for the British pound/US dollar just because it's what I've traded the longest and traded the most. I strongly dislike, and that's putting it mildly, euro/US dollar in the short term. I find that it's heavily traded, and there's a zillion levels of support and resistance. That means it has far less likelihood to break out of a range and travel very far, or even stay within a range and travel far, and so in the short term, it does not provide the kind of opportunities that I'm interested in at all. In the longer term, the British pound/US dollar is still my all-star favorite, all-time greatest currency pair ever. I love it the most. I don't trade the euro/Canadian dollar ever in the longer term. It's really a shorter-term type of currency pair.
What is it about the euro/Canadian dollar that makes it such an interesting pair for you? Because we are sure many traders have never even looked at that currency pair.
Well, in the shorter term, it's one of my favorites because if it tends to break out, there's very often nobody on the other side to catch it, meaning there's not another set of orders on the other side waiting for it to get to some level based on an option or large stop-loss orders. I mean, when the euro/Canadian dollar starts to move, it is because there is actual real momentum behind it, and therefore it is not advisable to get in the way of that in a short term. However, in the longer term, It doesn't tend to trend for long periods of time very much and isn't susceptible to the type of analysis that I do on the longer term for other currency pairs, and it therefore simply does not test well for me in the longer term. So, if it breaks out of a recent level of support or resistance that's been intact for a couple of days, it's far less likely to stop very quickly like the euro/US dollar or even the British pound/US dollar to a certain extent. I attribute that to the fact that it's not as heavily traded, there's not as many people waiting for it to get to certain level, and so it is sort of off the radar or not really paid attention to.
You've talked a lot about these systems that you're trading. Do you typically have your favorite system for the week that you're trading, or are there some systems that only give a few signals every so often, and that's why you're okay with trading multiple systems at one time? How do you manage that? Because there are so many different indicators out there, and there's so many different ways that people could trade, potentially creating a lot of counteracting signals.
I'll only really focus on 2 different strategies at the same time. That is, I'll have 2 strategies that I'm willing to trade, and 1 strategy at least that's sort of in the laboratory being ready to replace a strategy that I'm no longer comfortable with for a variety of reasons. I might be bored with it. My schedule might not be able to accommodate that strategy any longer, or quite frankly, it might not be profitable any longer. It might have gone outside of the statistical deviation of where it's supposed to be producing results. My short-term system on any given currency pair like the euro/Canadian dollar will produce anywhere between 5 and 10 trades per week that last anywhere from 15 minutes to 12 to 18 hours at the very most on the far outside of the bell curve. Then on the longer term, I'll really only be opening trades 2 or 3 times a week at the very most. Those are generally going to be on the British pound/US dollar, or the US dollar/Swiss franc, or maybe even the Canadian dollar/Japanese yen currency pairs. So I'll be somewhat diversified, and I'll be waiting on one time-frame chart for the longer-term system to play out. And on the short-term charts, I'll have some activity that I can take advantage of, and everything else just gets blocked out. Like I said, I'm a back tester as a career, so the majority of the time is spent verifying that what I'm doing is falling within the statistical norm of what I should be expecting. I also experiment with new versions of the systems, all the time, to make sure I'm getting the most out of each of them. And very little time is actually spent in scanning the charts and hoping that I see something that I like. I've always found it to be far more detrimental to my trading to open up the charts in the morning and just look around for some action than it is to say, here's the time frame I watch. Here's the system I use, and that's it. That's all I am going to focus on. There could be 1,000 pips out there on every other time frame chart, but I don't care about it. When I hear people say that they missed a trade on the US dollar/South African rand because they weren't looking at that chart, and they've got 25 currency pairs on their screen, and they're missing trades all the time, I always tell them that I missed on dating Julia Roberts in college, but then I never even met her. I never had a chance anyway. We're sometimes expecting to be able to take advantage of opportunities that our schedule really doesn't allow for, our mental capacity really doesn't allow for, and our trading capital really doesn't allow for. But we still get involved in it because we want to have a piece of the action. This fear of missing out on market action is what gets traders into trouble because we start to make trades out of a desire to make money instead of reasonable analysis. If you think of other professions, you can realize where specialization and focus come into play. The best lawyers are specialists in one type of law, the same for doctors and accountants. Successful traders are the same, so why should it be any different for a retail forex trader? If I specialize in the British pound/US dollar in the long term and the euro/Canadian dollar in the short term, if it does well and pays the bills, then there shouldn't really be a whole lot of temptation to experiment with real money on any other time frame or currency pair.
So you like to only trade the New York session, which is 7 a.m. to 12 p.m. EST. Do you ever place a trade afterwards?
I'm willing to place trades afterwards, based on the tested results of the system that I use, but it is very rare that the euro/Canadian dollar, for example, will create a New York session box trade after 12 noon. So I'll either miss that trade or take it later in the very rare circumstances that it occurs outside of the 12 noon time, which is usually between 1 and 2 times a month at the most, and that's my main short-term trading time. I'm generally always available during that time to take trades. In the longer term, I'm opening trades anytime day or night because my setup only happens 2 to 3 times a week at the very most, and I can see them setting up from a mile away. I publish the idea, I actually plan ahead for it. I know that it's coming. I set alarms and I've got a PDA that can tell me when the price is getting close to the entry and I make myself available. I make the sacrifice and I make sure that 2 or 3 times a week. I'm available, and it's usually not that inconvenient for me to be up an hour early or wake up in the middle of the night for a few moments to make sure that the entry has triggered and it's what I expected it to look like. Then I just let it sit and I don't worry about it after that.
On your shorter-term trades, do you ever use longer time frames for verification? Do you care about what's happening on the daily charts at all, or do you just focus primarily on your own short-term signals?
I have a reputation for saying that confirmation is for Catholics that are 12 years old. In seminars, I like to ask why people look at other indicators, and they always say confirmation, 'cause that's the C word. I generally say that the difficulty in actually agreeing to place a trade increases proportionally to the number of time frames that a trader will look at, meaning the more time frames and currency pairs that a trader looks at in order to actually justify taking the trade, the more confused that trader generally becomes because there could be conflicting signals. There would be a completely justifiable short-term buy trade on the British pound that would conflict completely with what someone might see on the 240-minute chart. What that does, in my estimation, is create a little bit of a conflict, but if through testing and statistical evidence, I can prove that incorporating a longer time frame chart into my shorter time frame trading makes it more profitable, then I'm perfectly willing to do it. Like I said before, I think nothing is really valid or invalid in trading. Only testing makes it so. That's one of my favorite quotes that I made up. You have people walking around all the time saying never do this and never do that. Well, testing is really what makes the difference in whether something works or not. So I am willing to do that. I've on occasion actually traded short-term from the long-term charts, meaning instead of looking at the long-term trend and then picking an entry on the short-term charts, I've actually looked at the long-term charts and basically just traded for the very short term when it hits a major level of support and resistance. So it was actually sort of the opposite of looking for confirmation.
So do you have any alarms or any beepers by your bed to tell you if things are happening overnight?
I've tried the whole gamut. I've tried the baby monitor thing. I've tried the making my computer make some horrendous loud noise in the middle of the night. And what I do now is I essentially set the computer to send an email to my PDA and it just buzzes or vibrates, and I'm sent a text message to the PDA.
What kind of equipment do you use?
I do 99% of my work on a Dell laptop, no extra monitors or anything. I do have a desktop that I can hook 4 monitors up to, but I usually have it running a music service or cable TV. At the office, I also have a few televisions and lots of food and music and other traders around me. It's a great environment for testing and trading.
What was your best trade ever?
On December 4, 2003, I bought the euro/US dollar at 1.2150, and I held on for 300 points. Every 25 or 50 pips, I added to the position. The euro was a rocket ship at that time, and I held on for dear life because I kept adding to the trade, and it moved so fast, I didn't have to hold it for long. This was one of the big lessons for me to realize that if I got the trade idea right, I needed to capitalize on it, and instead of taking money off the table during the trade, I needed to move my stops up with the move, and then add more to the position. The key was to be aggressive when I was right. In this particular trade, I was very fortunate to seize the moment and pounce on the trade because we don't get long trends every day or every week in forks. But when we do get a trend, it's really important that we get the most out of it. I should have held that trade a lot longer if you look at it from a historical perspective. But there were not a lot of us back then that thought 1.3000 itself was a reachable goal.
What was your worst trade ever?
My first account, it was that first trade that lost 90% in 72 hours. I had bought the euro, and I was enjoying a 10 or 20 pip gain on the trade when I read some commentary online from some guy that said that euro was going to fall. I trusted someone else's convictions without testing anything for myself, trusting in the analysis of a person I'd never met. I shorted the ever-loving heck out of the euro/US dollar, and I held on because I was sure that he would never be handing out advice that was not top-notch. He would surely never be wrong, and he positively knew what he was talking about. Of course, his idea was garbage and I had done no testing to prove that he knew what he was doing. Of course, I took double the size of my regular trade. Of course, as the trade went against me, I added more. Of course, as it really started to go against me, I sunk away and acted like it wasn't happening. It was a demoralizing experience, to say the least. My friend who invested in the account with me was very supportive and basically said, "Never do that again." We remained friends.
What is your favorite part of trading?
I think it's solving the pieces of the puzzle. It's approaching a problem, and each trading system that I build or each trade that I take is really the foundation of having taken a complex set of information or data and coming up with a solution, and then getting somewhat immediate feedback. So I like that process of the immediate feedback loop and putting together the pieces of a puzzle.
Do you think it is more about entries or exits?
It's about both. It's about money management and entries and exits and being disciplined. It's a complete package. I hear nonsense all the time about, it's not where you enter, it's where you exit. And I have been guilty of saying those types of things myself, and I was wrong if I ever did say it. Trading successfully is more like surgery or flying a plane. You've got to get all of it right. You can't say as a surgeon, it's not about the incision, it's about the stitches later on. That would mean it's okay to cut a leg off to do a skin graft. As a pilot, it's about the takeoff and the landing. You've got to get both right. And how do you get them right? You test. You never trade anything before you test it.
Let's talk a bit about the business of trading. How often do you pay yourself or extract your trading profits?
Every 2 weeks. I actually am set up as a business and I am an employee of the company. I get paid and taxes are withheld automatically. This makes it a lot easier at the end of the year. We are paying taxes along the way. I've been told 1,000 times that this is not the most economical way to do it, but I live well. I don't ever have to worry about it, and I am very happy.
What do you do about medical bills, insurance, basic life expenses?
We run the medical insurance through the company, and I have very few basic life expenses. My wife and I try to be very frugal. We try not to spend a lot of money, and a lot of rooms in our house don't have furniture. To put it succinctly, we've tried to live below our means. To put it less succinctly, a wise trader told me that when I was learning to trade that I should not attempt to live like a successful trader. I see a lot of successful traders who have doors on sawhorses for desks, or work on an old computer, or who still drive a used car. I also see a lot of unsuccessful traders who are driving new cars, have lots of credit cards, have brand new computers, and who spend a lot of money as if they've already started to make a lot of money. It's a matter of personal preference, of course, but I prefer not to spend money.
Right now you do some coaching and mentoring, correct? How many people have you coached and mentored?
1,057.
How many of those are profitable?
At any given time, I'm in close touch with or I'm tracking the performance and communicating with anywhere between 550 to 600 of those traders. This means I'm not receiving an email from them every day, but they're updating their performance on my website, or I'm in touch with them often enough to understand how they're doing. So I can't speak necessarily for all 1,057 of them in every moment of the day, especially the ones that I worked with in 2002 or 2003 that are long gone and just basically moved on, whether they're either doing well or not. But in that 550 to 600 persons, you've got a group that's about 50% strong. That is, they are actually profitable week in and week out, or at least at the end of the month, meaning they're able to produce a consistent amount of profits on a regular basis, not 1,000 pips a week, but something reasonable. For example, there's one individual who does between 400 and 600 pips a week. There's another individual who I worked with in New York. She recently discovered that she was really a 20 pip a week trader, and consistently since early summer this year, every single week. Week in and week out, counting the losses and wins every week, she comes out net 20. She's absolutely positively consistent with that, and has been able to increase the size of her trades to make 20 pips worth more money. Then there's a group of people in the 30% range that are still struggling at break-even or up slightly better or slightly worse. These are individuals who work full-time, who have external pressures, who are new to the training, and who don't have a background in trading at all and are having a seriously difficult time working with the terminology or just the fundamentals. Finally, there's the remaining group that for a variety of reasons, because my training isn't adequate for them, or because they simply weren't as serious about it as they thought they were, or because they're impulsive, or because of whatever other reasons, they're still losing money, or because I am not helping them in the way that they will respond to. I'm making some changes to the way that I train people to do a better job of conquering some of the deepest trading problems that some of this group have. I have flown unsuccessful students out to my office and put them up so that I can work with them personally. I haven't been able to make every single trader a hedge fund manager, but I have done a good job of laying the groundwork for a lot of people.
Is there any strong characteristic of a person that gives you a sense that they're not going to make it, or is not cut out for trading?
I don't know the right way to put this, and I guess I can be as immodest about this as I need to be to explain it, and I don't mean it to be that way. But I can generally tell from the beginning if someone's goals are somewhat outlandish, meaning if someone on day one of the training writes to me and tells me their goals for the training are to make between 1,000 and 2,000 pips per month, or to take a 10,000 account and double that account before the end of the month. I can then really tell from some of those types of catch phases that I'm working with an individual who needs some deprogramming. So I invite them to consider some alternative perspectives so that they can approach trading from a different mindset. Those people don't always listen, though, because they're under some type of external pressure. When you're trading to pay your bills, it's significantly more difficult to stop when you're ahead by $20, especially when your gas bill in the winter is $250. They've got pressures on them that are more than just what an average impulsive individual would have. The second type of individual who's a little bit behind on the curve is going to be somebody who's just naturally impulsive. Someone who naturally makes decisions that are significant, really quickly, doesn't put a lot of thought into it, talks a lot about how their gut reaction to something is, zis, and they have a feeling that it's going to go up or down. Those types of individuals I invite as well to consider a different mindset and perspective. The people whom I can recognize are more successful at times are the people who seem to be very laid back about the training, meaning they're not as severe or have a type of personality about the training or trading in general, but who are the type of people who enjoy testing and enjoy experimentation and are interested in validating or verifying the success of a system before they actually implement it with real money.
You mentioned earlier that you have a network of traders that you trade with or communicate with. Are these all former students or external colleagues?
90% of them are former students. The rest of them would be professionals in the industry whom I trust, whom I might write and say, I'm in the middle of this trade right now, and it's just awful, or it's going well, etc. Basically, people who have different experience and can offer me a little bit of perspective. So there are people outside that range. But I feel really comfortable working with people who are former students. I am in the office right now in West Virginia, and here with me there's an individual from London. There are 2 people from Florida, 2 people from Arizona, and they're all former students and they just come out to hang out and test and trade. They're at varying levels of success, but that's really actually irrelevant. It's really about having a group of people to interact with, collaborate with. We sit down in front of the whiteboard and we project the charts onto the whiteboard where we can write on it. We actually back test together on a regular basis and make it a part of our daily routine. These types of people, they come and go as they please in the office, which is perfect since the office was open for that type of thing to take place.
That's great. Does your wife trade at all?
No.
She has no interest.
No interest whatsoever. She attended the French Culinary Institute in Manhattan and she's a pastry chef, so she has interests that lie in different areas.
Wasn't she working at a hedge fund before? When did she become a chef?
Kind of off topic, but not so far off the topic. She worked 2.5 to 3 jobs the entire time that I was in law school to pay the bills, and she got up at 4 o'clock in the morning to go downtown to San Francisco to reconcile trades for a hedge fund. And this hedge fund manager lost between $70 and $80 million in one day on OEX options. My wife was reconciling the trades the day after all these option trades blew up, and that represented at least 35 or 40% of the total assets in the fund at that time. So she worked all kinds of jobs and worked just a ton of hours to help us get by.
Why did you decide to settle in West Virginia?
I'm in Wheeling, which is outside of Pittsburgh, Pennsylvania, and this is a long version of the story, but I sold a business to a group of people in Charleston, West Virginia. I traveled to West Virginia, loved the state, loved the pace of life. I'd lived in big cities my whole life, so my wife and I visited here and settled down to live in a place that was safe, quiet, close enough to a big city that we could get everything we wanted.
Do you think that having children has changed your trading style at all, or at least the times that you can trade?
Significantly. In some respects, it's like anything else that would take your focus away, but in another respect, I want to spend time with them instead of doing other things, so it's not like having a regular job where you don't want to be there and you're thinking about trading. With having kids, I could care less about the charts, and I just want to focus on them. Before, I was much more used to getting up earlier and taking far more short-term trades. But as soon we adopted our first son, I became much more focused on developing systems and trading from the longer-term charts.
Did you ever play any sports?
I was a wrestler, but I was 0-1, and the only reason I scored any points was because the guy kept throwing me outside that circle. And every time he threw me outside that circle, they gave me 2 points, which I guess was the penalty for throwing the guy outside the circle. So, actually, at one point in that match I was ahead of him, because he'd throw me outside the circle so many times and then he pinned me and it was over.
So do you think this ultimately sums up the whole fact that you don't have to feel competitive with other people?
I'm not sure that this one experience did anything except hurt my pride for a few years. But now I'm very competitive with myself, and I hope that I could be described as the type of person who is not very competitive with other people. I do believe that. I don't really care if somebody does better than I do. It doesn't matter. I'm happy for them. Trading is never about the money. It is about the quality of life and whether I can continue to solve the puzzle, so to speak. I'm not one to hang myself over losses. One trade is 1 in 1,000 that I took before and 1,000 that will come after. It is a lifestyle. For example, I managed some accounts for a while and they didn't go as well as I would have liked, and I let that go. I found that I dwelt on the losses more when it was other people's money, and I was far more emotionally stable when I traded my own funds. Trading my own account is a career choice I made. The losses and ups and downs come as part of the experience. I'm a better trader than I was last year and the year before and so on. And I'm going to be a better trader next year and the year afterward. It's a process. You don't just walk into a law firm one day and decide that you're going to be the managing partner. You gotta work your way up. Through it all, I've never really honestly considered giving it up just because I wasn't doing as well as somebody else.
Any parting words?
Yes, one thing. I seriously dislike it when I hear people say that they've been taught they should trade only with money that they can afford to lose. I might be the only guy saying this out there, but I seriously believe that that phrase is enormously damaging because it teaches people that the money they're using to trade is not significant enough to be protected. First and last and most important thing is that I'm a defensive trader. So I feel that there is no excuse for losing the entire amount of trading capital, meaning if that's money that people can afford to lose, then I'd rather have them give it to me and I can take them to the movies and we can take a long walk on the beach, hang out together, and we still have something to show for it later. But it is not money that people can afford to lose. It represents somebody's financial future. We would never move into a house that we could afford to have burned down. We would never buy a car and only buy it if we could afford to have it smashed into a semi-truck. But we regularly open our trading accounts with money that we say we can afford to lose, and so it's as if we're from the beginning saying, well, this money wasn't very important to me. I think to a certain degree that the money that we're entrusted with to trade is sacred money that not only represents the amount that's in the account today, it represents what it could be later on in life, the quality of life that it could provide for someone. So it's much more important than just money that someone can afford to lose.
Lessons from Rob Booker. Fit trading to your personality. In this interview, Rob Booker has shared with us some of his favorite trading techniques. However, we feel that the key lesson to learn from this interview is that knowing yourself is more important than any particular trading strategy that you may choose. You need to make sure that your style of trading is in sync with your personality. If you are a short-term trader, you should focus on short-term profits. If you are a long-term trader, you should focus on longer-term or bigger profits. Furthermore, you should never trade a strategy with a significant amount of capital without back-testing and forward-testing it first. Test everything. Before Rob Booker implements any strategy, he will spend hours and hours studying the mechanics of the strategy to understand when it works and when it doesn't. He feels that his job is to be a back-tester first and a trader second. Therefore, his cardinal rule is to never trade a strategy unless he can first prove that it has been profitable in the past. For new traders, back-testing may sound daunting. However, it does not need to be as complicated as it seems. There are a lot of different ways to backtest. The fancy way is go out and learn a programming language to generate results systematically. However, even though Rob Booker knows how to code now, at the beginning he back-tested everything manually. One easy way for new traders to start is to simply review the charts going back in time to look for instances when your setup triggered a buy or sell signal, and to record the actual performance of the trade at bare minimum. We encourage traders to first look for at least 20 to 50. This depends on the time frame you are trading, samples of the pattern, and only after that we recommend traders move into forward or live testing phase. This means that the strategy is actually traded in current market conditions using either a demo or mini account. The reason why this is important is because the psychological element of trading can always alter results by revealing the difficulty of reacting to live market conditions. Along the same lines, a minimum of 20 to 30 winning trades needs to be made before the strategy is ready for prime time. Don't fall victim to possum trading. Rob Booker believes that you should never let yourself fall victim to what he calls possum trading. When a trade is going bad, it may be very tempting to shut off the computer and hope that it will all get better if you stop watching the market. However, this almost never happens. Instead, more often than not, the losses will only become greater. Therefore, it is important that we all focus on trading defensively. Trading is a game of survival. If you can protect your capital, you can always live to trade another day. This is why Rob Booker's first goal is to not lose money, and his second goal is to find a way to grind out profits consistently. He feels that one of the biggest mistakes is to trade only with money that you can afford to lose. Of course, he is not suggesting that everyone should mortgage their houses and trade with money that they cannot afford to lose. But what he is telling us is that every dollar, yen, pound, or euro is hard-earned. If you are trading with money that you can afford to lose, then it means that you are trading with money that you feel is not important enough to be protected. The money you trade should be viewed as potential wealth later on in life. Therefore, before risking it in the market, you need to make sure that you are risking it in a smart way. You only want to apply it to strategies that have already been battle-tested rather than just jumping into the markets on a whim. Chapter 4. The coolest guy in the room, Chuck Hayes. Of all the traders we've interviewed, Chuck Hayes is one of the coolest guys around both in temperament and in style. He makes his living in the highly chaotic world of E-mini stock index futures where the difference between fortune and failure can be measured in seconds. Yet Chuck rarely loses control, and he often wins by violating some of the most sacrosanct rules of trading. Brutally honest, Chuck believes traders should first understand their individual strengths and limitations and trade accordingly. A very generous trader, Chuck has counseled and coached scores of futures traders in his own free time. Due to his natural Midwestern modesty and nonchalance, Chuck tends to downplay his accomplishments. He is, however, one of the best risk-takers in the retail trading game. We had the pleasure to interview Chuck from his home office in Minnesota. Were you exposed to the markets in your childhood?
Oh, much later in life. I didn't do any trading until 1999.
What about investing prior to that? Did you have any experience with stocks at all?
No, none.
What did you do prior to that?
I used to take some distressed businesses, some of them were convenience stores and a nightclub, and I would try to fix them up and resell them. Then I worked as a product manager for companies designing automotive test products.
So what made you switch to trading? Did you just like that industry?
You know, I went to a seminar where they were talking about trading options on stocks, and I actually did that a little bit while I was still employed. But it wasn't very long after that where I figured out that the options markets was really not the way go. It was too expensive. They didn't trade nearly enough. There were a lot of disadvantages. So I decided to stop working and go strictly to day trading.
The seminar you went to, that was your first exposure to finance. What really tickled your fancy? Why did you get so interested in that subject?
I think it's the same reason that people would love to do what I do, which is the lure of short days, high profits, high risk. Unfortunately, that's not really the reason people should go into what I do, but that is what the allure is.
How long did you trade options on the side before you came to the conclusion that this was a pretty losing proposition for a retail trader?
About a year.
How was that process? Did you break even? Did you lose some money? What was the end result?
I think that, looking back, I probably did all right for a while. But like a lot of beginning traders, I ended up losing all of my profits on 1 or 2 trades by getting stubborn.
Were you trading news events? Would you buy options in anticipation of some positive news?
I was probably more of a technical trader. I never considered myself very good at interpreting news, even today.
How did technical trading come into your skill set? How did you gravitate to that right away?
Oh, that is a great question. Well, let me add to that a little bit. I think that almost every trader whom I mentored as far as stocks or futures go wants to make it a science. They want to be able to look at charts, study, work hard, find some magic indicator of solving the market. In the end, I don't think that's how successful traders trade. But in the beginning, it seems that everyone goes through that process.
They try to engineer a profit, right?
Absolutely, and I see it all time with new traders. And no matter what you tell them, you can tell them up front that this is not a science. It's very beneficial to be a good chartist, but that's not what will make you money in the long run. Coming from my technical background, I wanted to make it a science protocol, and I think that probably for the better part of my first 2 years of trading Nasdaq stocks, I still tried to make it a science. I was very fortunate the first couple of years because I traded after the tech bubble burst of early 2000. We had some great down markets, and I was a much better short trader than I was a long trader. It was really later on when I decided that the reason there are so many technical indicators out there is because none of them work very well.
How did you even find out about technical analysis? And what did you do to teach yourself the basics of chart reading?
I read the book Trading for a Living by Elder.
That was the foundation. And then obviously you looked at thousands and thousands of charts.
Yes, I was fortunate in the beginning to realize that you couldn't go out and trade a lot of different instruments and be good at them. In the beginning, I only traded 3 or 4 stocks, and I didn't deviate from that.
What stocks did you trade in the beginning?
In the beginning, we had Rambus and CMGI and Yahoo and QCOM. All those stocks that were skyrocketing $10 to $20 a day. We don't have great stocks like that today.
You entered the day trading business around 1999.
July of 1999.
Tell us a little bit about that. What did you do? Did you join a firm, and what was that like? What was your experience just walking in that first day?
We were real fortunate here in Minneapolis to have a firm called NBX Trading, and they catered to and specialized in day traders. So we used the firm's hardware and traded strictly for commissions.
What were the commissions like for you in stocks?
They were 3 cents per side.
So it cost you more than a nickel to just get in and out of a stock.
Yes.
This was before decimalization, so you were still trading in 16ths and 8ths and quarters, right?
Yes, it was interesting. I was looking forward to decimalization, but it really ruined the markets for day trading stock.
Because it narrowed the bid-ask spread and made the markets very, very thick.
Author's note: decimalization greatly reduced the difference between bid and ask by reducing the spread to sometimes just a penny. Therefore, a trader who bought on the bid and sold on the ask saw his profit margin squeezed by more than 90%, from 12.5 cents, 1/8 of a dollar, to just 1 cent.
Exactly.
1999. This was the go-go years of the internet phase, stocks moving $10 to $20 a day. You say that you're a better short trader than you are long trader. But this was still the last of the long run. How did you manage to succeed in that environment?
I think it was really tough for the first 6 months. I was fortunate that in 2000 the market started to go down. But that time I had been at it for 7 or 8 months, and I had a pretty good idea what I was good at. And then for the next couple of years we had wonderful down markets, and it was easy to make money, it really was. But I have found out from being around successful traders that almost all of those successful traders are better one way or the other. They're either better long or better short, and they know that.
When you first started out, what was your initial capitalization?
I started with $150,000.
So you were pretty well capitalized. And then did you give yourself capital aside from this to live on? So this wasn't a situation where you had to make money right away.
Exactly. I think it's a real handicap for people if they are in a situation with the high cost of living and a lot of payments. It is very, very difficult to make money. As a matter of fact, I found with traders who are struggling that if they absolutely have to make money on some particular day, they will lose money.
How much time did you give yourself internally? Did you say, I'm going to give myself 6 months or a year before I succeed?
I don't really remember. I do remember in the first year that I lost $50,000, and that was pretty good actually.
So you were realistic enough to understand that this was going to be difficult, and you had to just stay in the game.
Today, I tell brand new traders that you are not going to make money in first year. I've only seen one trader do that who traded futures. But he had a huge amount of experience trading markets prior to moving to futures.
When you first started trading, what was your basic strategy?
The same thing as today, although I would love to be a better swing trader I know now, and it took me a couple years to figure this out, that I was a great scalper. I like to play a lot of contracts, sell a lot of shares, for very small profits over and over again.
You would basically fade extremes right from the beginning.
Yes, and if you had first seen me trade, I was no different then than I am now.
So you've really stayed very consistent right from the get-go. You remained in sync with your core personality.
Yes.
The first year you lost $50,000. Why do you think that was? Was it a matter of just learning how to have better timing? Better risk control? What were you doing wrong then that you've improved since?
I think it's a matter of seeing an entire year's worth of markets where you to go through earnings season. You need to go through slow times. You need to see a holiday season. You need to see all those kinds of markets. At the beginning, you make too many mistakes. I think the first goal for all traders is to learn how to stop losing money. For me, that means not trading in the middle of the day and realizing that the very last hours of the day trade differently than the first hour of the day. It's a process where you learn to stop making so many mistakes.
Can you give a more detailed idea of how the first hour of the day sets up, and then the last hour of day? What are the differences between the two, and what are the unique characteristics of each one of those particular parts of the day?
I think the first hour is when we see a lot of retail customers and volume. We also have a lot of news early in the day that gives us knee-jerk reactions to play. When you get in the middle day, where the volume drops off, there are different forces at work. I'm not great at sensing those. Fade trades do not work nearly as well in the middle of the day. When you get into the last part of the day, when you have funds balancing their positions, it is much more difficult to fade the market within the last half hour, and that's what I'm best at. After doing this for 7 years now, I know that. I understand that about myself, and I try to be more careful of the trade at the end of the day. I also trade much smaller sizes at the end of the day.
So your most confident trades are at the beginning of the day.
Absolutely.
If we were going to distill it to one simple sentence, and obviously it's much more complex than that, but the overarching philosophy is this. You tend to have lots of news flow at the beginning of the day. Lots of excited retail order flow, lots of what we in the business call dumb money, which is just sort of money chasing news. Your basic modus operandi is that once it reaches an extreme, you begin to fade it, because then you're going to get some retracement and rebalancing, which provide you with profit opportunities.
Yes, absolutely. That's what I have made my money doing.
Of course, that sounds a lot simpler than it is because finding the top or the bottom during those times is much more difficult in real life. Timing is everything.
Timing is everything, and I also understand that I am unlikely to get the best entry when I first take the position. I almost always expect to add to the position when I take it.
So you are always a scale-up, scale-down trader. Your first trade is almost always probative, right?
Yes, I firmly expect to add to it anyway. It increases your chance of success a great deal when you understand that, because trying to make perfect entries and book them, if that's what it takes for you to make money, then the market's going to take your money and you're going to lose.
On a day-to-day basis, that's a great strategy. However, we all know that it comes at a very substantial cost, because in a one-way market, that kind of a scale-up strategy can just decimate your profits. You can lose sometimes a week's worth of profits in one trade, right?
Yes, that's true. But I wouldn't say it takes a week's worth of profits. It certainly can be hard on you for one day. We've experienced some of those markets right now where the Dow wants to go up to all-time highs and the rest of the market kind of creeps up with it. If it trends, it's very difficult to make money. However, we are not in that sort of trending market very often.
Do you have a mental limit to how many times you will add into a trade? When you just say, that's it. It's a one-way market. I'm getting out. I have to cut my losses.
You know, a lot of people ask me that. A lot of traders around here ask me that. I don't look at it that way. If we have an average of an 11-point swing in the ER, a daily move from low to high in the Russell 2000 of 110 ticks, every day you know you might be able to take a point and a half or two and be fine. But if we have a 20-point normal range, you might get 3-point shakeouts and you need to trade accordingly. If you simply trade by hard and fast scientific type rules, eventually the market will take your money.
Could you explain that a little more? Let's say the average trading range in the Russell 500 is 10 points, just using 10 as an equal number. If you're using stop losses of 1.5 points that are within the noise level, you'll just get stopped out continuously. Is that what you're saying?
What I'm saying is if a spread goes against me a point or point and quarter, I may add to it there and do very well on the trade. What I'm saying is there are some markets where we had an average range of about 18 or 19 points a day like this summer, in which case, 1.25 points or 1.5 points stop probably won't work.
So when you have this massive range expansion, and obviously you never know that it's going to occur, you never know you're in the midst of hurricane until everything swirls around you. What kind of risk control do you apply to yourself? Do you have a hard and fast rule? Or is it always matter of feel?
I think it's always a matter of feel for me.
Is there a monetary limit where you'll say, I just dropped $50,000, that's it. I'm not staying in this trade anymore. Is there an absolute uncle point for you? Or are you always assessing the dynamic of the market?
Yes. Days I quit trading are the days where I just don't have a good feel for what's going on. It's like a pitcher having a bad day. You have to walk away and come back the next day with a 0 on my P and L and start over.
When you first started doing that, obviously you would have many, many successful days, and then you would have some very bad, big hits to your equity. How did you deal with that psychologically?
I think that's the key to being a survivor in this business versus some people who are still sitting on the sidelines now. Oftentimes people ask, how did you do today after the market's closed? And I usually know. Every once in a while I can't remember. It's just a game, and I get to start over again tomorrow and do the best I can. I don't have to worry about yesterday.
You basically come in every day with a clean slate.
Absolutely.
It's like having no memory, and that helps you to have no emotion because you're not carrying all those scars around with you.
Absolutely. And if people looked at me without looking at my P and L, they could not tell from my actions, activity, or emotions whether I'm up or down.
Do you look at the P and L during the day and let it guide you? Or have you now learned to just look at the numbers, whether you're down 20,000 or up 50,000 and not really get too emotional?
I don't care, no. My goal is to make another good trade based on what's going on in the market. It doesn't have anything to do with last trade or the trade before or my P and L.
Obviously, that's great principle to aspire to. But in real life, what's the maximum amount of bad trades during the day that you've run into? Did you ever make 4 or 5 consecutive bad trades where you would either short, 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 long, 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 and it would go completely against you?
I can tell from experience that if I make 4 or 5 bad trades in a row what the day is like. It's a day where it's creeping up all the day long. It always looks toppy to me, and after making 4 or 5 bad trades, I'll just come back the next day. I've never found a good trader or a great trader who is good at every kind of market, and I know what my weaknesses are, and I'm going to have those days once in a while. In the long run, we are going to have creeper days 2 or 3 days a month. I'm going to have another opportunity tomorrow or the next day. A lot of new traders and a lot of people who are not trading anymore, they just know they're right and know they've got to make one more trade and then know they're going to have to win. Well, it doesn't work that way.
Let's go back to the start of the career. You were trading for about a year, day trading stocks, starting to hit the big NASDAQ bear market. Your second year in the business, what happens? What happens with your stock trading?
I'd go in every morning and I'd try to be done by 9:30 a.m. my time, which is 1030 a.m. market time, and I'd typically leave the office. I learned early on that I was a first-hour trader, so I practiced going in for an hour and a half, trading and leaving.
You were trading for an hour and a half and then just leaving?
Yes, because I was very, very good at the first half of the day. It was a discipline that I learned that worked for me.
What would you do the rest of the day?
Sometimes that was a challenge. I did find that once I left the office and I couldn't trade, I wasn't tempted to go back and make one more good gambling trade. I love to win. I learned to accept that after the first hour, it wasn't going to happen. $500 or $5 or $5,000, walk away and string together those winners day after day after day.
At that time, did you create any kind of a monetary target for yourself every day?
No, I still don't do that.
Do you think that is a dangerous game to play for traders?
Yes, and, as a matter of fact, I think it's a huge mistake for people to set monetary goals.
Because it forces unnatural trades to reach those goals, right?
That's true, and there are some days where there's a lot more opportunity. You can set a $500 goal and you quit at $500, maybe the day offered $5,000. It's about going in and taking what the market offers you, making good trades.
So you basically learned to win. The second year, you obviously started to have better profits. What happened next? You now have 2 years under your belt as a day trader and obviously reached a certain level of success. How do you discover stock index futures?
I was in a chat room, and one of the guys in there is always commenting about trading futures. So I asked him in private if I could call him and ask him why he did that, and I did. He said the bottom line was if you go trade futures and you are successful at it, you will never look back.
Many of the equity day traders whom we've interviewed tell us that stock index futures are where equity day traders go to die. It's the single most difficult market in the world to trade.
I think that it is by far the most difficult in the world to trade, but somebody makes money at it.
So he said once you get into futures, you'll never go back. So what happened then?
I started dabbling in both. I was trading 2 stocks and I traded the S&P 500 and the NASDAQ 100 futures. What was interesting is that I was good at trading the S&P 500, and I typically would lose a little money trading on the NASDAQ. So I stopped trading in NASDAQ and started trading strictly the S&P 500. About 3 summers ago, the volume in the E-mini S&P 500 increased to such a level that it didn't want to move, which kind of lost its profitability. So I started looking for something a little more volatile, and the ER.
Author's note: ER is the futures instrument for the Russell 2000, an index of smaller capitalization companies that tends to be much volatile than the S&P 500 or the Dow Jones Index. Moves about twice as much per day as the S&P 500, which means you either make money twice as fast or lose money twice as fast, right? It is the hardest game in the world, but it's also the best game in the world.
What makes stock trading and futures trading so different?
Volatility. Think about this. The Russell 2000 is trading at around 730, and it represents $70,300 worth of stocks, but you're only going to need a couple $1,000s to buy the contract. So for $2,000, you can buy $70,000 worth of stock. It's very highly leveraged. It is traded by the best of the best, and their objective is to take your money, and they're very good at it. I tell new traders it's like deciding you're going to play football and lining up against a professional team your very first day. They're going to kill you.
What about the physical differences between the two markets? The fact that stocks have a level 2 with various market makers displaying a variety of bids and asks, whereas futures are traded through a central anonymous book.
It's been a while since I traded stocks and looked at level 2. There are probably fewer games played with futures. However, that doesn't mean that there aren't plenty of games played.
The anonymity of the book makes it advantageous to trade because it hides your own order flow. But it also makes it extraordinarily difficult to read the true directionality of the instrument, wouldn't you say?
I think that's true. The other thing is, I hate for people to try to read too much into what we're seeing in the book. If I were a couple hundred contracts into a trade and I wanted to sell them, I certainly wouldn't put them out for sale and show them. I would try and hide what I'm doing, and I think that's true of all the really big traders and the really great traders. So I tell people, if it is not on the inside of the bid and the offer, it doesn't mean a whole lot.
So what's the basic protocol for you to try and read the price action in futures?
Prior to being in a trade, I'm pretty much watching the chart. I'm not watching order flow very much. Once I'm in a trade, I watch the order flow a little better. I will watch for who's refreshing on the bid and the offer. But prior to that time, I'm pretty much a chart trader.
So you'll enter on a chart signal, but manage the trade by watching the book itself, the order flow.
Yes. I don't know if that's good or not. It's just that I have a difficult time watching the order flow if I don't have anything at risk.
What about the order flow catches your eye and makes you say this is interesting? This is something I need to react to.
I think all traders probably follow order flow a whole lot more when they're on the wrong side of the trade. It's true. I really pay a lot more attention when I'm out of the money. Every once in a while you'll notice that someone continues to sell or continues to buy at a certain level, and that's a lot more obvious if you are a few ticks out of the money. If I'm in the money, I don't pay much attention to it because I like to try and stay in the trade longer.
Are you going back and forth between the book and the chart? Is the book itself overlaid on the chart so you can see both the price action and the chart action at the same time?
No, these are 2 different programs on different PCs.
Do you physically look at both screens? Or do you really almost forget the chart action once you're in trade and you just look strictly at the price action.
Oh no, I watch the chart. But I guess the point is, prior to being in a trade, I don't pay a lot of attention to the book action.
You use activity in one index as clue to a potential movement in the other index.
Yes.
So if you see one index beginning to move, let's say you see the ES starting to move but the ER is stationary, is that enough information for you to try a long trade?
Definitely.
Do you always add to positions? Or are there some probative trades where maybe it doesn't go your way? You don't have that much confidence in your position, and you just simply say, hey, I'm wrong and I'm going to get out.
Lots of times.
So it's not an ironclad rule that you're going to add to a position continuously. A lot of times you'll just come in and out and take small hits if you're not really feeling it.
Sometimes I make a small trade just to get a better feeling for the market.
When you make that kind of a small trade, and you say you want to get a better feel for the market, what makes you feel the market better by making that small trade?
Forces me to pay attention.
Forces you to focus. So the biggest benefit is that now you have money on the line and you want to pay a lot more attention to price action.
Yes.
Could you give us an idea of your basic day? How do you start it? What do you do?
One of the worst things for me is to go sit at my computer too soon. If I get up early and I go sit at my computer, by the time 8:30 or 9:30 market time, I am so ready to trade that it's bad for my trading style. I'm a whole lot better off to come in 15 minutes before the market opens, look at the major headlines, look at the chart structure. I don't really pay attention to what happened overnight and make trades. The riskiest trade in the day is the first one, in the first 5 minutes.
Why is that the riskiest trade of the day?
You begin to see who the dominant forces are, whether they are going to try to move the market up or down, and you want to work hard in that first 45 minutes because that's when the best opportunities exist.
What kind of clues do you see in price action that would make you think, oh, they're going to start moving the market up today?
Actually, this morning was a great example. The market gapped down. They managed to push ER down a couple of points, and it was real obvious when you watched the book to see the buyers move in, and they were willing to buy everything that was for sale over and over again. So this morning was a pretty good example of when we had the opportunity for the market to go down. The bulls moved in and bought it up.
So seeing that made you join the bid and come in with the buyers, right?
Yes.
So you try to come in maybe 15 minutes before the open, clearly focus on the first 45 to 90 minutes of trade. What happens then?
Then I really want to get away from it for a while. The middle of the day is not what I'm good at. I think most day traders would tell you that is certainly not where they make most of their money. I like to leave my house and go do something else for a while.
Can you give us an idea of your office setup?
I use one PC for nothing but charting, and it has 4 monitors on it.
What kind of time frames do you look at?
It changes all the time. However, I will tell you that I always have a 15-minute chart of ES and the ER. I have a 5-minute chart up of both, and then I have another chart that I continually play with. I am just like every other trader. I'm always looking at different indicators. I'll play around with them for a while, see if there's anything to them. Most often there is not, and I'll clean the chart off and I'll start over.
Are there any indicators that are sentimental favorites, or at this point you almost look at a clean chart? You don't even really have indicators on it.
I really am in favor of moving averages. What I use is something called move trend, which is very similar to a moving average. I will always have those on my charts. Everything else is optional. Author's note, move trend is a proprietary indicator that tries to create a more timely moving average.
Do you use that because it removes the noise and gives you a cleaner view of the directionality of the move?
Exactly, and that's why it's also important to have a 15-minute chart up looking back several days and see what the trend is. It's very easy to get focused in on a 3-minute chart or a 1-minute chart or a 5-minute chart and miss the big picture. The bigger size is trading longer time frame charts. You don't want to fight those guys.
To take that to the next step, if you're starting to see selling action on the short-term chart, but on the longer time frame chart, it looks like it's really an area of support, then it's probably a good, high-probability trade to be a buyer at that point.
Yes, and I think that right now that is never more evident than looking at a daily chart on the S&P 500. We've been in a long uptrend. But we'll have 2 or 3 days in a row where it looks like a bear market, and then the big boys move in and then it will build up some more.
One computer with nothing but charts on it. What else is in the trading room?
Well, I guess that one trading PC has 4 monitors and I play around with different charts. But I stick to the most basic 5 and 15-minute charts, and they're always up there. On my other PC, I have 2 monitors. One runs the execution platform through the brokerage firm. I will keep a web browser up so I can look at the headlines on a couple of news sites. I'm not real big on news sites. I look at Dow Jones, and I'll look at CBS Market Watch headlines. I don't dig much beyond that because I don't care what's happening with individual stocks. I only really care about the direction the market is moving. Then, as you well know, I run my own chat room.
So, overall, this is enough to give you the flexibility you need.
It gives me everything I need.
Do you come back to the screen at around 3 p.m. East Coast time?
In the last hour and a half, I like the first 30 minutes to see what the market is doing. The last hour of day is when the volume picks up a little bit, and although I'm not nearly as good as an end-of-the-day trader, I will come in and try and make a couple of good trades.
Would you say that, on balance, by the end of the day, you're going to try to maybe join the trend more than fade it? Of course, every day being different, but if you see strength, do you usually want to go with that strength?
Yes.
And will you follow the same methodology if you see strength? But there's a little bit of retracement initially. You may add to the position a couple of times just to stay true to that bias.
Yeah, I think that's true. I guess the modification that I make at the end of the day is that I am a lot less likely to fade the market.
But you'll still use those multiple entry techniques to position yourself.
Yes, I think you increase your chances of success several-fold if you are willing to scale in and scale out.
Clearly, every trade is very different, but what would you say is the average time span of your trades?
Less than 10 minutes. I have a lot of trades that last less than 2 minutes.
Is that difficult for you emotionally or mentally, since futures markets can be extraordinarily fast? I mean, prices can literally go up and down 1 or 2 points in a matter of 20 seconds. Do you like that? Or do you find that discombobulating?
No, that's what I like. Give me the volatility, give me short time frame trades, that's what I like.
The longer you're in a trade, the more antsy you get.
Well, if I am in it for 30 minutes, I'm probably on the wrong side of it. If I was on right side of it, I would have taken the money and moved on to the next trade.
You find that it's the skill of your trade management that really turns potentially bad trades into good trades.
I wish I could say I'm always on the right side and they always go my way, but typically I'm early in my entries, so I expect them to go against me a little bit. It would be nice to always go with the momentum and have it always work out, but that's not typically the way it goes.
Would you say that you're even sometimes surprised if your first entry tends to be the turn trade?
I don't know if I'm surprised, but I'm certainly happy about it.
In futures, you have a centralized book, first come, first serve market. There is no discrimination between large and small players. Is that a great attraction of the market for you?
Yes, it is very, very simple, very straightforward. It's a very difficult game, but very simple, and I do not think that it helps us to try to make it more complicated.
Is that because basic price action is highly repetitive day in and day out?
Yes. However, I think it's important, even though we see the same things over and over and over again, that most great traders are going to find they are good at 1 or 2 things, and they practice those same things over and over again. Although we see the same patterns, you're not going to be good at trading all patterns in all market situations.
What kind of patterns do you feel you're best at trading?
I'm best in a choppy scalper's market. I am worst in a trending, creeping market. I could be better and take the middle out of the momentum move or swing move, but it's just not what I'm good at. I'm much better at sensing the tops and bottoms and trading those.
We talked a bit about the fact that the futures market is the most leveraged financial market outside of foreign exchange.
Author's note: leverage in futures can reach 501.
That could be very advantageous, but also it can be very dangerous. Personally, how much leverage do you think a trader should use trading futures?
I tell new traders 2 things. Number 1, they should have at least $10,000 in their account for every single contract they trade, even though their broker will allow them to have far less. I tell them if they want to be here next month, next year, then they better have that much money to trade. You're going to have days you lose money, and you're going to make mistakes. I also tell traders that if they do not start out with a $100,000, their chances of making it in this business are very, very slim because they're going to run out of money. They're not going to make money for the first year, and they're going to pay some tuition to learn to do this. So, if they come into the market with $20,000 or $30,000 and a mortgage payment, a car payment, and a kid in college, they might as well just give me their money because they'll lose it.
Just to delve into that a little bit deeper, one of the things that most novice traders don't quite appreciate about futures is the commission cost that comes with the market. Even though commissions on a relative basis are extraordinarily cheap, the amount of trading you do during the day can really add up. Can you give us an idea of how many round turns you typically do during a day?
Well, that's a tough question because it depends on your style. If you're going to be a momentum trader and trade 3 or 4 contracts, you may only make 3 trades a day. If you are like me, where I'm willing to take the money and trade size, it's not unusual for me to trade 20 times a day, or even 25 or 30 times in the first hour. However, on one move, I may make 5 or 6 trades because I'm making multiple entries and multiple exits.
But altogether, let's just say we take 20 round turns per contract. That works out to basically be about $100 at retail prices, perhaps a little bit less, maybe $70 on a deep discount basis per day. That's per one contract. So if you're trading, let's just say 5 contracts, that's $500 in commissions that you must overcome every day aside from all the P&L issues.
Author's note: a typical commission from a deep discount futures broker would cost $5 per contract per round turn. So trading 5 contracts 20 times per day would cost the trader $500 in commissions expenses alone.
Yes.
Which means that in 10 days, that's $5,000, and in 100 days, that's $50,000 worth of commissions. So you are already in the hole, even if you stay completely even on your P&L.
Exactly. If you take a person who comes to the market with $250,000, the chances of them being there a year from now is very high. If a trader starts with $30,000, the chances are very, very low. It doesn't have anything to do with their ability or their discipline. It just has to do with what's going to happen as they learn to trade. Let me add one more thing. We were talking about the decimalization of stocks, and I don't know what stocks trade for now. What? 1/10 of a cent commission or something like that.
It's about a half a penny.
Well, the nice thing about these futures is we have decimalization. The SB 500 trades in quarters and Russell trades in dimes. 1 tick will cover the commission. If you made 1 tick.
Author's note: a tick, the smallest incremental value that a futures contract would move, is worth $25 in the mini S&P contract and $10 in the Russell 2000 contract. With commissions set about $5 per contract, if the trader was able to net out just 1 tick at the end of the day, he would be profitable in those instruments.
All day long on any of those instruments, you will make money.
Futures traders quite often don't even think about points. They talk about how many ticks did I make today. You do that kind of internal accounting with yourself. You say I picked up 20 ticks, 10 ticks.
I don't think about that at all. Instead, did I trade well today? Did I do what I'm good at? Did I trade my plan? Did I take what the market offered me? I don't think in terms of ticks or points.
You said you've mentored some students. How many have you mentored?
30.
Out of those 30, how many have become profitable?
4.
So basically 10%.
Yes.
The odds never change, right?
The odds do not change. And what's interesting is in the first 90 days you can tell whether or not a person is going to make it.
What are some very strong clues that a person is not going to make it? What are the key characteristics that just make a person not cut out for trading?
They try to make it a science. They're stubborn and losing trades bother them too much. They're afraid to push the keys on the keyboard.
When you look at somebody who has promise, what would be the primary characteristics of that trader?
If you give me someone who wants to be the best at whatever they do, and I don't care if it's ditch digging, building houses, or whatever they will do, whatever is necessary to learn to win or succeed, I can make a trader out of that person.
So it's really the inherent desire to be a winner in whatever activity you're involved in.
That's true. If you took guys like Michael Jordan or a successful businessman, they will learn to be the best at whatever they do or the best they can be, and they'll do whatever they have to do to achieve those goals.
Do you like athletics? Do you follow sports?
Yes.
You find that the prototype of a successful trader or successful day trader in futures tends to be someone who is highly competitive and has some kind of athletic background in their history.
Yes, I know most about golf because I play a pretty good game of golf. I think that I could take almost any person whom I've played golf with who is exceptionally good at it. I can probably teach them to trade because, by definition, if they are a good golfer, they are very disciplined. They're adaptive and they make the best of it. They don't take excessive risk. They're always calculating that best way to win.
This is a question we've asked many day traders. Are you competitive against yourself or against everybody else?
Myself.
For you, it's a matter of self-discovery and self-improvement. You don't care about anybody else and what the market is doing and the fact that some other guy is making 10 million or losing 10 million today.
No, that doesn't even enter my mind.
Were you always interested in sports and had a competitive nature?
Yes, and what I find interesting is I don't enjoy playing racquetball or basketball or golf just for the hell of it. I like the competitive side of it, like a lot of men do.
So it's not the art of the game that interests you, it's the practical results.
Yes.
Very interesting. These are questions we ask everybody for the book, and we'll just ask them of you. So answer them with first thing that comes to your mind.
Okay.
What is your number one rule for trading?
Don't be stubborn.
What was your best trade ever?
You know, it's odd because it happened this summer. We had particularly volatile markets in June and July. We had a market that was just screaming up on news. I couldn't even tell you what it was, and I faded that market, and it took a little while, but I made $69,000 on that trade.
Because the market retraced the whole-up move.
The whole-up move, yes.
So that was sweet. The converse of that, what was the worst trade that you can remember?
It was this summer when Bernanke opened his mouth and started talking about the easing of interest rate rises and the market started creeping up, and then it jumped. I was already in a trade, and I got stubborn when, in reality, I should have just taken the hit at the first time. But that stubbornness made me have a bad trade.
Did you average into the position before you threw in the towel?
Unfortunately, in that case, I was already in the position when he said it. I was short 200 contracts for the ER, and as soon as he said it, you know it automatically just spiked up 4 points, and that's pretty costly. Typically, when you get a spike like that, you hope it will retrace 50% and you're going to get out. In this case, it just continued to go up, and all you have to do is shake those off and come in the next day and make good trades. I just don't want it to turn into a life-changing situation. I bailed. I walked away from the market that day and came back the next day.
You take that big hit, then you close the screen and you walk away.
Two things. Sometimes there's nothing you could do about it. Sometimes you have situations in the ER where somebody wanted 200 and they entered 2,000, and it will crush the market. There is nothing you can do other than walk away and make good trades, and most traders really struggle with that. You watched me trade enough to know that my strength is coming back from a bad trade because I just try to make more good trades, do the same thing over and over again. Physically, if I'm struggling, what I like to do is trade size for a very small profit. I'll maybe trade 50 or 100 lots for a half point and do the same thing over and over again.
Just to get the rhythm back and to regain some loses.
That's right. String together some winners, some singles.
So clearly the one thing you never do is you don't try to get everything back at once. Let's say for argument's sake you dropped 5 points on a trade, and then your methodology is I'm going to take half a point, 3/4 of a point to constantly chip away at that loss.
Over and over again.
How did you come across that kind of a methodology? Was it natural? Or is this something you really consciously realized was the right thing to do?
You know, I think I learned the hard way. Revenge trades are the most costly trades. If you have a bad trade and you try and make it all back in one time, you're going to lose more money. Think I learned from experience that the best thing to do is to try and get back to even over a little bit at time. It's a whole easier to make a half point on 100 contracts than it is to make 10 points on 10 contracts.
What was the most interesting part of this job?
You know, people would think that the answer would be making a lot of money or the short workday, but that's not it at all. Winning the game is really important to me. Working with some good traders is important to me. The rest of the things take care of themselves. If people get into business because they think it's easy, they're kidding themselves. It's the toughest game in the world. And trading for an hour and a half or 2 hours a day is probably far more work than the average person puts in their 8-hour office job. It is very, very tough. It's tough emotionally. But I like to try and teach people to succeed and learn to do this, knowing very well that only 1 in 10 are going to make it.
What about drudgery? Is there anything unpleasant about his job?
No, I look forward to it every day.
The wide array of trading that you've done over the last 6 or 7 years, what would you say was the most humbling trading experience for you? The one that really taught you the most?
I don't know. I think I probably learned far more from trying to teach new traders to trade than anything that I did myself. One of the things that I'm sure you know, I've realized that all new traders are going to go through some experiences that are similar. They will have some dumb luck. They will triumph and then they'll have some failure. They'll modify their plans. They'll get punished a couple of times by the market. They'll get tentative. Everyone I've ever taught went through the same progression. It's the people who know how they react to that adversity that tells you whether or not they're going to make it. Have you ever seen anyone who just made it from day one?
Never for long. We've seen people literally take $10,000 and run it to $250,000. But we've never seen anybody hang on to it unless they were able to master the skills. Usually the same attributes that were responsible for that massive gain, greed, and fearless risk-taking also become the reasons for their downfall when markets turned against them.
Exactly.
Lessons from Chuck Hayes. Know if you are better at being a short or long trader. Just as few people are ambidextrous, very few traders can trade equally from both sides of the market. Typically, some traders are much more comfortable being long while others have a much stronger preference for being short. There is no right choice in this matter. The distinction is really a function of your individual personality and taste. However, as Chuck Hayes points out, knowing your strengths can often be the difference between success and failure. Just as throwing left-handed for a righty can be an extremely uncomfortable experience, trading long for a short biased trader can be highly unpleasant, even if the trade is ultimately a good one. Being a short biased traders ourselves, during the peak of internet bubble, we remember making 4 profitable short trades in Inktomi Inked in one day as the stock climbed 16 points from open to close. The issue wasn't whether the stock was going up or down, but how we handled each trade. Because we were much more comfortable on the short side, we executed with confidence and precision and walked out a net winner at the end of that day, proving Chuck's point. Traders who absolutely have to make money never do. This is perhaps one of the wisest pieces of advice in our book. Many retail traders get into the business expecting to make money right away. The irony of this profession is that the more you need to make money to pay your bills, the less likely you can do that. The main reason that trading is difficult to master is that it is the only profession in the world that actually punishes you for non-performance. Most workers who work on a salary have the peace of mind knowing that they will be paid their weekly paycheck, whether they accomplish their tasks or not. Even salespeople who work strictly on commission risk only the loss of their time, not their money, if their deals go bust. Trading is the only profession in the world where a wrong decision will result in an instant loss of your money. Few people truly appreciate the negative pressure of this dynamic. Chuck Hayes lost $50,000 in his first year on the job. Therefore, if you are going to trade full-time, it is absolutely critical to understand that success takes both time and money. Focus on the next good trade. As human beings, we are all highly influenced by our surroundings. As traders, we are especially vulnerable to big emotional swings, cycling from depression to euphoria, depending on the outcome of our last trade. Yet real pros never look back. What happened on the last trade has absolutely no impact on what happens on the next one. The markets do not care if you just lost or made $1 million. They only focus on the future. That's why good traders are able to totally divorce themselves from their emotions. As Chuck says, he only wants to concentrate on making the next good trade, ignoring the good or the bad that preceded it. It takes time to see different type of markets. One of the reasons why trading takes a long time to master is that market environments are not static. Markets do not simply go up or down, but rather cycle between trending and ranging phases. It takes a very long time to learn to understand the nuances of each regime and to make proper adjustments to your trading style. In fact, the markets are littered with stories of traders who made a fortune right out of the gate because they caught a very strong trend only to give it all back when the market started ranging. That is why in trading there is just no substitute for experience. Timing is everything, but you will rarely be right on the first try. At its core, trading is nothing more than timing. However, timing the entry is an extremely difficult skill to master, and few short-term traders ever get it right on the first try. That is why Chuck Hayes will often add to his positions. He even coined new terms for his style of trading, shad for short ad and lad for long ad. This practice is a very controversial because it flies in the face of the long-accepted market wisdom that traders should never add to their losing position. However, like all trading rules, this one is meant to be broken when properly executed. The key is not to allocate all of your risk capital to the trade at once, but rather to distribute it properly so that you achieve a good blended price on the trade. As Chuck says, I firmly expect to add to anyway. You increase your chance of success a great deal when you understand that trying to make perfect entries and book them more often means that the markets are going to take your money and you're going to lose. Chapter 5. Rags to riches, Hussein Harnecker. Imagine losing your life savings in a partnership gone wrong and having to pick yourself up from such a calamity. Hussein Harnecker took 7 months to save up $1,000, an amount that most college students can easily earn working for a few weeks at local restaurant, and started to trade foreign exchange. Hussein is as conservative as it gets. He refuses to trade a strategy until he has tripled his demo account 3 times in a row. He goes for 10 pip trades once a day, which may seem minuscule to most, but in the last 3 years, he has turned that approach into an average profit of $500 a day. With his systems engineering background, he has been able to design his own automated trading system, which makes sure that he never turns a winner into a loser. His cardinal rule is to never trade his system during news. Having been broke before, making money on a consistent basis is far more important to him than becoming rich overnight, so he locks in profits as often as he can. From his office in South Africa, Hussein sat with us to share his story of how he managed to go from rags to riches. How did you get started in the financial markets?
As a South African, back in the 1980s, our education system did not include any subjects related to finance or investing. We had a subject called accountancy, which is basically like bookkeeping. But we did not cover anything to do with investments. The curriculum of those previously disadvantaged did not include these subjects at all. So, with little or no experience, these opportunities were virtually non-existent to disadvantaged communities and people in those communities, including myself.
Do you live in South Africa right now?
Yes, I'm currently an information technology, IT systems engineer. I originally studied mechanical engineering and then switched to IT. I was quite successful as an IT engineer and I have worked for 2 companies. Both of them were liquidated, and after the last liquidation, I decided that was it. I've had enough. I'll start a company on my own, and I went into a partnership with 5 other guys. After a year or so, that partnership went horribly wrong, and I ended up losing significantly both financially and in terms of self-esteem. At that point of my life, I was at an absolute low. I don't think I've ever sunk any lower than that. I was truly down and out. I was obviously unemployed. I remained unemployed for almost a year, and honestly, having been brought up to believe that a man is the only breadwinner in the family, one of the most humiliating things was lying in bed sleeping while my wife had to get up and go to work. Looking back now, I learned some very valuable lessons during that period, which has still stood with me for the past few years.
Like what?
Lessons about planning, being careful, about managing money, about trust, and having trust in other people. Documenting things, signing them, making sure you have witnesses to absolutely everything that you do when it comes to business. I think those are some very, very valuable lessons that I learned that have stood with me since then. It also taught me about compassion, basically feeling for other people as well, because up until that point I would say, fairly successful. Being in that situation, you never really think too much about other people and what their situation is until you end up in it yourself. After the partnership blew up, I had huge debts to pay, and I was not getting anywhere close to settling them. At the time, I had a friend in the United States, whom I had met a while back, who used to trade currencies. For no apparent reason one afternoon, he suddenly just popped into my head, and I thought of contacting him to see if he can assist me in any way, so I got a hold of him. He asked me for $1,000, which he said he would invest for me to help me improve my financial situation. The only problem was that I did not have $1,000. I wrote back to him and I told him, "Listen, Stephen, let me save up for it, and once I've got 1,000, I'll give it to you, and then you can trade it." He actually wrote back to me and he said, "I will loan you the money and I'll help you out." I told him that I was in so much debt already that I would not take another loan from anybody. I had reached the bottom line. I said, "Give me a chance, let me save up for it," and it eventually took me, I think, 7 or 8 months to save up $1,000. When I finally did, I emailed him again and told him that I had the money. He then turned around and told me, "Listen, instead of me trading for you, I would rather teach you how to trade." This was something that, I must say, I truly appreciate it because it gave me a skill that I would have for the rest of my life, and one that I would be able to share as well. So that is basically how I started trading currencies.
It must have been frightening for you in the beginning because you had spent so much time saving up that money. How were you able to trust this friend given all that you had gone through in the past? Did he show you a track record?
Yes, he did show me what he was doing. He basically sent me the printouts of his trading records and his account statements, etc. As far as I was concerned, this guy was making huge money.
Was he doing it for other people as well?
No way, strictly for himself. Generally, he would not touch other people's money. I suppose in my case he was going to make the exception to the rule. But then, on second thought, he decided to teach me his skills instead. Effectively, it was technical analysis with an emphasis on moving averages. At the beginning, I first demo traded it. I did very well on the demo, then went live, and that was when the rude awakening came.
How did you learn from him when he was in the United States and you were in South Africa?
He used to take print screens of charts and put them into PowerPoint. He would then illustrate the images and write on top of them and basically give me slides of the graphics. When I received them, I would replicate what he told me on the demo account. For example, I would plot a moving average of 5 and a moving average of 13 to look for a moving average cross. I was such a novice that I had no idea what this guy was talking about at the time.
I'm sure there was a very steep learning curve. Did he explain to you what moving averages were, or did he just say, okay, these are moving averages, and I recommend that you use them?
He basically advised me on what they were. I would then figure out for myself how to apply them. If you're basically looking at crossovers, then you want the faster line to cross the slower line from the bottom up, creating a buy opportunity. If it crossed from the top down, that's a sell. I actually battled with it in the beginning, but I somehow slowly but surely, and through perseverance, managed to get the hang of it.
Did you read any books about technical analysis to get a better grasp?
At that point, nothing at all. I became quite successful at demo trading, and that was when I went live, which was when I got the shock of my life. The first day, I'll never forget it. It was a Friday. I placed my first trade on a mini account, and it was a nerve-wracking experience, but I walked away with $6 on my first trade. On my second one, I made $5, and at the end of the day, I had made $18 in total.
So your friend was basically a mentor to you. How often, then, would you talk to him in the beginning?
Yes, that's right. In the beginning, I spoke to him about once or twice over the telephone, and then the rest of our communication was all done via email.
Would you correspond over email every single day or every few days?
Initially, almost on a daily basis. I estimate that it lasted for just over a month or so.
So it sounds like you traded exclusively on technicals in the beginning. Did you ever incorporate fundamentals into your trading?
It was probably 5 to 6 months down the line before I discovered the importance of fundamentals. Although Steve was very good at teaching me technical analysis, he did not explain the importance of news. I only learned this by knocking my head several times. To give you a simple example, if I was in a buy trade, which I'd opened at 9 a.m. and suddenly, at 1030 a.m., my time, that trade would turn against me horribly, and I could never figure out why this was happening. At one point, I actually stopped trading because I had lost 3 times in a row, and that petrified me. I became so scared that I could not trade anymore, and I would only look at charts on a daily basis. Every single day in the afternoon, I would call up charts, and I would study them. That was when I realized that roughly 1030 a.m. and 230 p.m. something would happen in the market. I didn't know what, but I would suddenly see a big spike either going upwards or another spike going downwards, etc. I asked the question on one of the forums about why it was happening, and I never got an answer until about 2 weeks later, when somebody mentioned one word, news. That's all they said, and I thought to myself, how on earth can it be news? When I saw the word news, I was thinking about a bomb explosion somewhere or a terrorist attack, which obviously is not what this person meant. It was only through further research did I discover the actual news release indicators and learned that they came out on a daily basis. I went out and tried to find as much information about them as I could, such as GDP, NFP, and so on. And what I would then do is avoid trading during those times. Even if my signals came up and if I saw that it was close to, let's say, 1030 a.m. or 230 p.m., I would not enter the trade. I would normally wait about an hour or half an hour after that period, and only then I would enter my trades. After doing that, I found slowly but surely my trading started to improve again.
How long did you demo trade for before you actually went live?
About 4 months.
What gave you the confidence to go live? Was it a series of winners?
No. I first asked myself the question when I go live, how much money would I start with? The answer was only $1,000 because at that point, that was all that I have saved up and all that I could afford. I even told myself mentally that if I'm going to start with $1,000, I need to be able to turn $1,000 into $2,000, irrespective of how long it's going to take me, whether it's going to take 1 month or 2 months or 3 months. That is what I needed to do. My line of thinking was that if I could make $2,000, I would withdraw $1,000, and at that point, I have recouped my entire capital. Whatever I lose afterwards is not as important because I've got my capital back. So my goal was to double my capital 3 times in a row back-to-back in my demo account. Eventually, I actually managed to do it, and in fact I doubled it 4 times in a row.
In 4 months?
No, not in 4 months. It was 6 or 7 months, and that was where I got the confidence to go live, but the transition from going from demo to live was not something that I had prepared for. Psychologically, there was a massive difference between trading demo and trading live. The reality is that when it's your own money on the line, it has a huge effect on you psychologically whether you are aware of it or not. I became hesitant. I would see the signals, but I would be too scared to enter the trade, and only later did I find out that if I entered, I would have made a large amount of profit. When I did get into a trade, I was completely spaced out. I would be so scared of things going against me. One of the main things is that my wife was very anxious about taking risks. She is not a risk taker, not even a calculated one. I never realized just how much of a role she actually played in my life when I first started trading.
Did she support or encourage you in the beginning?
I wouldn't say she encouraged me because, in the beginning, she felt it was money that would go down the drain and that I was basically wasting it. I had to work with her until one day she said to me, "Fine, if that's what you want to do, go ahead and do it." My reasoning to her was, "Look, just give me a chance. If I blow the $1,000, that's it. I'll turn around and I'll walk away and I'll never mention trading ever again."
Did you show her your results on your demo?
Yes, and I think that is where she probably got the motivation and started to think that if he's doing that successful in the demo trading, maybe he can do the same with live. So eventually she said, "Listen, if that's what you want to do, go for it." But my agreement with her was that if I lost the $1,000, that would be it. I would turn around, walk away, and never look back. My belief was that I wouldn't want to turn around in, let's say, a couple years and ask myself what if I had tried it. I am the type of person who would rather give it a shot, win or fail.
So did your wife keep a tight noose on you after you started trading?
No, the first couple were small, successful trades. But there was one day that I had entered into a trade at work, and when I came home, I logged on to my trading station, and I was $187 in the profit, and my wife was ecstatic. Honestly, I can tell you, she was jumping up and down. Now $187 to an American citizen might be peanuts, but to me, as a South African, that was a small fortune that I had just earned. She was ecstatic, and from there on, I grew stronger and more confident in my trading. Her excitement made me more determined to trade successfully. I mean, we've had our ups and downs, but she's always stood with me. In fact, she's thinking of becoming a trader herself. The key to my trading strategy is small but consistent daily wins.
Let's talk about your trading. First of all, what hours do you typically trade?
In GMT, from about 7 a.m. until, I would say, roughly about 6 p.m.
What is your typical holding period? Are you conservative, aggressive?
I'm fairly short-term.
Did you have some sort of daily, weekly, or monthly pip target or dollar target?
Yes, originally when I started out, my target was simply 10 pips a day. If I achieved that, I would not trade again.
So you would be disciplined enough to close your position?
Yes, I would take the 10 pips and stop. If I made it at 10 a.m. in morning or whenever, that would be it. I would be finished trading for the day and I'll wait for next day. The reason I'm mentioning this is because I reached a point early on in my trading career where I was starting to overtrade.
That's a problem a lot of people face.
Yes, I would make the 10 pips and the trade was over. But then later on I would see another signal and I end up getting into a new trade that would become a loser. This went on until I realized that I was really just a 10-pip trader, so I would take that profit, stop and wait to trade again the following day.
How long did it take you to discover that?
It was probably another 2 months or so into my trading before I discovered it. I was not looking at the dollar amount. I was only looking at the pips because I told myself that I needed to become consistent and focus on the pips because I could obviously increase my lot size and make the dollar amount something I would be satisfied with. Now, believe it or not, it's been 3.5 years since I started trading, and my pip target is still the same.
So you aim to make 10 pips a day, but what you would do if you had a losing trade? Would you try to make 20 pips over that 10 or stick to the 10 per day goal?
No, I would still just go with my 10. The aim is that your total number of wins exceeds the occasional loss. I would always have a fixed stop loss. I used to trade with a stop loss of 20 pips. If I lost that 20, then I would stop trading, wait for the next day, and would follow exactly the same plan that I had before, which is to only go for 10 pips a day. I wouldn't try to trade 2 or 3 or 4 times a day just to make up that money. What I realized nowadays is that the anger seems to drive you to trade again. You become so angry with yourself about losing the 20 that all you want to do is get it all back, and you think that you're going to teach the market a lesson. And unfortunately, it doesn't work out that way. It's more likely that the market is going to give you a beating instead.
Do you like to focus on one currency pair at a time, or will you trade multiple currency pairs?
No, only one.
So then, what are your favorite currency pairs to trade?
Euro/US dollar and British pound/US dollar.
Which ones would you avoid?
Probably US dollar/Japanese yen.
Is there a reason for that?
Yes, I've burnt my hands on it a couple times. I think it is because the price action can be a bit too wild for me on occasion.
Do you ever trade the crosses?
No, not at all. About a month ago, I created a system for trading the British pound/US dollar currency pair, and that system is working phenomenally well for me. So I'm actually at the moment only trading the pound. I also have a system that trades silver as well, so I focus on those two exclusively right now.
Can you describe how you start your typical day? Do you just survey charts, or do you check the calendar first?
At around 7 a.m. The first thing I will do is look at the news to see if there are any major releases to be careful of that day. If it's a very quiet day, the first signal normally appears within the first 2 hours. I'm trading on a system or model, so I've got a little alert that notifies me when the trade sets up. As soon as the alert rings, I enter the trade, I set my profit and I set a stop loss, and after that, I just forget about it.
So you actually set your target for 10 pips.
That's right, yes. Since I have a system to see how my trades are progressing. If I am up 6 or 7 pips, then I'll look at the indicators again. Should I feel that this trade is going to turn against me for whatever reason, then I would close it out for the profit. Once I've reached 10 pips profit, I also close the trade even if the indicators are indicating that the price may still go in my favor.
What kind of equipment do you use for trading?
I use a compact P3 laptop connected to my cell phone for internet access.
Does your trading platform come with charts?
Yes, you can actually trade off of the charts. It was a program developed by a Russian company. It uses very, very little bandwidth, which is one of the reasons why I like so much. Also, besides currencies, they've offered trading in the metals, gold and silver. If I ever trade from home, I use a laptop, which I then connect to my mobile phone to access the internet.
Do you end up trading at work or at home more often?
Work, definitely.
And your company's perfectly fine with that?
They are perfectly fine with it, yes. In fact, a lot of them want me to teach them how to do it.
In the beginning, you told us that during specific hours, news flow would affect your trading, and you would avoid it because of that. So how often would you check the calendar for news flow then? Every single morning or once a week to figure out the times of day that you may not want to trade?
The habit is every single morning. In fact, sometimes I will look at those calendars even 2 or 3 times a day to see if I have forgotten anything that may be coming up in the afternoon. I actually did try to trade the news in the past with a beautiful, subtle sort of strategy for news. But what I found was a bunch of blocks. For example, the platform would freeze only during news times, and that actually made it completely impossible to trade efficiently. The specific news release that I used to trade was non-farm payrolls. I had so many problems technologically that I just told myself it wasn't worth it to trade the news anymore.
A lot of people don't trade news because of the same problems, and they realize that if they have a solid strategy, money can be made in any sort of time frame.
Yes, that is right.
So, basically, would you say that most of the resources that you use are free?
That's right, yes. The trading platform and live charts are free.
Do you feel that it is necessary for someone new to invest in something that's expensive, like one of the premium charting packages?
No, don't invest in expensive charting packages. Live charts are available at no cost with equivalent information. I love reading and I love learning. I think that's part of the challenge of working in FX. I spent like $90 here, $150 there, etc. But what I found was a lot of the books that I purchased were quite honestly not worth the paper they were written on. They taught the standard issues such as the moving average, crossover, or stochastic. I don't even think these guys took the effort to actually thoroughly test the strategies that they were teaching. Admittedly, the strategies would work once or twice, but more times than not, they would not work. This actually leads me to my next point, which is that just over a year ago, I backed off trading for a while and turned to my current software provider because they gave me the ability to program my own indicators. I had met a Russian guy on one of the forums. The two of us started chatting, and he's the one that actually made me aware of the platform. I started learning as much as I could about indicators and robotic or fully automated trading. I was fascinated by it and actually got to the point where I can now develop my own indicators, and I have my own robot, which basically does the trading for me. I've got one robot which is quite successful as long as it is shut off during key news releases. It requires a little management, but nonetheless works well if I turn it on and off because news can kill the robots. You need to keep him out of the news, which is something that I learned in forward testing. I've actually got it honed down now. I know exactly when to switch him on and when to switch him off. I started giving classes in South Africa where I teach people how to trade using the robot. In the beginning, I had about 4 guys, and I've now probably have about 16 live traders.
Do you think systematic trading is really necessary? Because you were doing pretty well in terms of a 10-pip target on a discretionary basis. Now that you've created a robot, what difference has it made?
A huge difference. When I was trading manually, I would set my target at 10 pips, my stop loss at 20, and then I would walk away from my computer. When I would come back, I would on occasion find that the trade had become a loser. Not because I was wrong about price action, but because I let the price go as high as 8 or 9 pips in my favor. But then, I let it reverse and turn what could have been potentially an $80 or $90 gain into a $200 loss. So where the robots come in very handy is that I've inserted a function into robots such that it will protect my profit. Effectively, if I set my pip profit at 10, I could leave in a 3-pip profit protection. This means that if the price goes up by 7 pips, then retraces to 3 pips, the robot would close the trade. So I've created a virtual trailing stop that would allow me to walk away with $30 in profit instead of $200 in losses.
So you feel like the robot basically helps you manage the trade better.
Absolutely.
You have any sort of alert system that you've created to tell you when a trade has been placed?
Yes, I do. Whenever the robot enters a trade, my alert would beep, and that is when I would know that the robot has entered a trade.
Do you think that having a trading robot has made your trading a lot more relaxed in a sense?
Yes, it has, because a lot of the time, I may not even be aware that the robot has opened a trade. I will come and check the platform and find that the robot has entered and closed 1 or more trades, in most cases successful ones. As you can see, with the robot, I actually have enough confidence to trade more. I am still going for the 10-pip profit, but but the trades are managed better so that I can build the profit if need be.
Does the same go for losses then, in the sense of letting the robot trade more if you have a loss for the day?
No. If I've taken a loss, then that's it for the day. I don't let him trade again. I'll turn the robot back on the next day.
So pretty much you stick to your original plan.
Yes, to my original manual trading plan, because the discipline to walk away with profits is the most important. The robot just makes it such that I don't need to be in front of my PC anymore to wait for signals. He is picking up signals as they happen, and he's entering the trade.
Do you feel like your IT background has given you an advantage in creating the robot?
Yes, it most definitely has, as well as some programming skills I developed in my early computing days.
Do you think people like you are much more likely to move to some sort of automatic trading than people that don't necessarily have it?
Yes, but even people who do not have that background are interested in robotic trading. In terms of the people whom I train, some of them are not that computer literate, and when they heard about what I was doing with the robotic trading, I've absolutely fascinated each and every single student with this concept. What I found was in the beginning, when they were trading manually, they would win and lose. But because I was doing so well with the robot, I thought it's quite unfair to not give the robot to these people and hopefully help them turn their trading around and make them successful as well. Everybody is telling me down here that I'm absolutely crazy and that I should be charging for the robot. But at the end of the day, it's all about helping people. As my student, you will get the robot with your classes, and I can tell you that it has made a phenomenal difference to these people. To be honest, they are not really trading, they are just switching the robot on and off. But I have made it a requirement for them to understand the mechanics behind trading.
Let's continue to talk more about your trading style. Do you usually go into the market with your entire position, or do you average up or average down into a trade and stagger your entries?
No, just one entry, one trade, and that's it.
What time frame charts do you look at?
Initially, I start with a 4-hour, but I take my signals from the 30-minute chart.
You said that initially you learned from your friend, and then you read some books afterwards. What has made the difference? Has it been the initial training with your mentor that really taught you most of what you're doing now, or did you learn more tricks of the trade later on in books or forums?
I learned more from the forums and my own research. It is on the forums where you have guys talking about actual strategies and things that are going on in the markets at the moment. However, the bottom line was that, at the end of the day, I plugged in each and every single indicator on the charts, one at a time, and I would sit and look at this indicator, understand it, analyze it, and critique it. If it didn't look easy to me, I would take it off, and I'd move on to the next one. Through this tactic, I found a group of indicators that I was comfortable with. The next stage for me was then to hone that group down until I had about 2 or 3 indicators. Once I had done that, and found the indicators that I wanted to use, it was then a matter of tweaking the setting until I got it to point where I was happy that, if X lines up, then Y will most likely happen. I would use the second and third indicator merely for confirmation, and that is actually when success finally came.
So your charts are fairly simple. It sounds like you have about 3 indicators on them, 1 primary and 2 for confirmation.
2 is confirmatory, yes.
Now, given that you have developed the robot, do you believe wholeheartedly in systematic trading, or do you believe that there needs to be some sort of discretion as well?
There should definitely be discretion as well. In fact, the most important thing about making this robot successful is the fact that you need to manage the robot. You need to be aware of when news is coming out, the time of day, and if there is news, then by 9 o'clock, 9:30 my time, I should be out of my trades before the numbers are released. In the beginning, when I tested the robot on the demo accounts, I let him run 24 hours a day. After about 2 weeks of trading, I analyzed all the losing trades, and the funny thing was that 90% of those losing trades were during times when news is released. That was when I realized that, if I just keep him out of the news, the robot was an absolute winner. So when I started applying the discipline of keeping him out of news, basically, that was when I finally became successful.
You hit on a great point, which is that one of the most important things for people to do to improve their trading, especially when they are not doing so well, is to take a time out, go back, and analyze the trades that were both successful and unsuccessful, because, more often than not, you will find a common theme of when you tend to lose money and when you don't. It could be one currency pair that for just some random reason you can't trade well. It could also be like in your case. Every time data comes out, you trade poorly. This is a great tip for new traders. What do you think is more important, indicators or price action?
A tricky one, but ultimately, speaking for myself, I rely on my indicators.
What was your worst trade ever?
My worst trade was when I opened a trade, and just as I opened it, the telephone rang and I had to attend to something urgently. I attended to the matter not realizing that I had not set a take profit or a stop loss. The trade was wide open. To make a long story short, I came back and I was down about $380, and I got the shock of my life when I saw that. In a state of panic, I just closed the trade, and it took me quite a while to recover from that.
Was there any lessons that you learned from this?
Yes, I will never, ever trade without a stop loss and a take profit. It's actually a habit now, where the minute that I open the trade, I will immediately put in my take profits and stop loss. My trading robot has been programmed that way as well. This is part of money management, which is critically important to a trader's survival.
What about your best trade ever?
My best trade was during non-farm payrolls, and actually it was when I broke all of the rules that I have now, or more specifically, before I developed my current discipline. In that trade, I made over $3,200.
Can you tell us a little bit what was happening during that time? Did you have large position on, and it moved quickly beyond your 10-pip profit?
I could probably have gotten more if I had stayed in the trade longer. But basically what I did was, at 250 our time, I opened a buy stop and sell stop, and I just waited, and suddenly the price shot up and my buy was triggered. I was trading, I think it was at 3 lots, which are $30 to a pip. 1, 2, 3, boom, before I knew it, I was $3,000 up and I just closed it. I didn't even think. I just clicked on close and that was it. My profit actually went a bit higher than that. It went up to about $4,000, but by the time I hit the close button and it went through, I was back down to about $3,200.
In terms of the buy stop and sell stop, is it something that you still use right now?
Not anymore. I used to only use it for news trading. But like I said before, because of the issues I've had with brokers and their execution around news, I've actually stopped trading this way and have advised my students to do the same.
It seems that you increase your positioning a lot more nowadays to make meaningful profits. Before you said that you had $1,000, so you were probably trading a mini account, right? Now it sounds like you are trading a regular account.
Yes, that is right.
Can you tell us a little about your success, in dollar terms and percent terms over the past few years?
I would say I've been quite successful, but the first few years were very, very difficult. I was winning and then losing and then winning and then making a little bit here and there. Right now, though, I trade the British pound in the early morning and then silver later on. Between those two, I earn enough to sustain myself from trading alone.
That's great. You trade every single day except weekends.
Every single day, but I have a tendency to not trade on Friday afternoons.
Do you ever hold positions overnight?
No, very rarely. On silver, though, I've had 2 trades that went overnight, I think.
Let's talk a little bit about silver. Why did you start trading that?
About 4 months ago, my eldest brother came to me. Now he's aware that I'm trading currencies, and he said that he wanted to trade gold. I said to him, "Why would you want to trade gold when you've got all of these opportunities in the euros and the pound?" And he said, "Listen, just do me a favor and find out whether the company that you trade with allows us to trade gold." So I went to my trading platform and checked that they certainly had gold, so my brother was the one that started it all. I opened up a chart of gold, I looked at it, analyzed it, and I was quite shocked at the move that gold actually makes. However, I realized that you need a lot more capital to trade gold. Silver is cheaper.
How long did you demo trade silver before going live?
I demo traded it for a month every single day.
It seems that you typically demo trade for a pretty decent amount of time before actually going live. Is that right?
Yes, the shortest will be a month.
Why did you decide to teach classes on trading?
It started off with 3 friends and 1 other guy who was interested. The 4th person was a friend of a friend. If you remember from the beginning of our discussion, it was only 5 or 6 years ago that I was financially crippled and practically broke. That period of unemployment was a very difficult period of my life. There were some things that occurred back then which sometimes, when I think about it, it gives me the creeps. The hair on my arms just starts standing up. So I promised myself that it was something I would not wish on my worst enemy. Yet the funny thing is that I stuck it out. I hung in there, and today, in my opinion, I am quite successful. So I felt that it was time to give something back, because I am a firm believer that the more you give, the more you will receive, not necessarily in monetary terms, but it could be in all sorts of other ways, and I felt one of the motivating things was that if I can do it, anybody else can. Originally, I was going to write a book, but I found it too difficult to put my thoughts onto paper. Also, through my own personal experiences, I realized that in order for the average person to succeed, they are going to need guidance. They are going to need somebody to speak to, and that is when I came up with the idea of offering the classes. I basically started with 3 or 4 guys who were friends of mine, and when they went live, they started doing fine, and they told their friends about the classes. From there, it's basically taken off.
Do you feel that having a mentor was really that much of an advantage?
I think you need a mentor. Somebody who you can speak to, because whenever I got stuck and I wasn't sure what was happening, I would be very nervous that night, and I would pick up the phone and call Steve. He would verbally explain to me what he was trying to say through email, and that made a big difference.
How long are your classes? How many days a week?
The classes are in the evening, Monday through Thursday. That's 4 evenings, and it's 3 hours per session. What I do is give them an introduction to the trading platform. I use my own indicators that I've developed, and basically, I show them how those indicators work for different time frames and how to use them properly. By Thursday, they are generally pretty good with knowing how the platform and the indicators work. Then, they need to go back and demo trade. Do exactly what I did, which is to triple that account 3 times over. They will also need to give me their demo account number and password so that I can track how they are doing and see if these guys actually follow the things that I have taught them. We also go through a process of analyzing their trades, especially the losing ones. I will help them figure out why they may have lost money in a trade, and typically, the problem is that they forgot to look at the calendar for news releases. This is a part of the learning process, however, and that is basically how I do the courses, and I provide a lot of support afterwards.
So it's a 1-week course, and the indicators that you've developed, do you send them in a file that they load onto a chart?
Yes, the course lasts from Monday to Thursday, and the indicators are sent to them in an encrypted file.
How many people have you trained so far, and what is their success rate?
I've trained probably just over 30, of which 16 are currently live. In fact, the 16th guy just went live today, so I'm not going to count him. 15 people have been trading live anywhere ranging from just over a year to 3 or 4 months. Out of the 15, 12, 80% have been fairly successful. The rest do not follow the rules. They trade on emotion, anger, etc., and take the occasional knock. There is one guy who took his account from $500 to $6,000, and in just over a month, he blew it all on one single trade.
It's called greed, isn't it?
Yes, greed is not something you can control in another person. You know your system works. That's the bottom line, period. How people treat the system is entirely in their hands.
Do you think there's a common characteristic amongst those people, whom you know just won't be able to make it versus people whom you think will succeed at FX trading?
Yes, I think that I've found certain characters who have a difficult time in this market. You can see immediately that they are very gung-ho, almost like gunslingers. I'll warn them over and over and over again. Forex is not a game. It's not gambling like in a casino. It's a very serious business, and it should be treated as such. It requires a phenomenal amount of discipline. However, sometimes these lessons need to be actively learned by these people. Once they've knocked their heads a couple of times in the live environment, then they will tend to pick up that phone and tell me, "You know what you said in the class? Now I realize what it was that you were trying to say." They cannot see it when we are merely talking about it, but once they've experienced it 2 or 3 times, once they've lost money, in other words, they become good traders.
Do you think everyone can be trained, or are bad habits just too ingrained in some traders?
I think that most people can be taught the discipline. Unfortunately, that's going to involve that person probably losing some money before he learns, but because it is his own money, it tends to pull him right once he's taken a couple of knocks. I've seen it with my own guys who have funded an account, lost it, refund it again, lose it again, refund it, lose it again, and then suddenly by the 4th time they are up and running and finally trading well. Very few do it right from the beginning. They will blow their account at least once. But these are $200, $300 accounts, nothing too damaging.
How much support do you give them after they've taken your course? A month? 2 months?
No, indefinitely. I'm available to them over the telephone or over email. We have regular forums in which past students who have become live traders convene to share their experiences, strategies, etc., and learn about new developments I may be working on. It's a good support network, as past students share experiences amongst themselves.
What is the number one rule or tip that you would give to new traders?
I think it is discipline, perseverance. Don't give up if you don't succeed initially. When you teach a person a strategy or a system, he wins his first trade and he's absolutely ecstatic. He wins the second one, he loses the third one, and suddenly the system doesn't work. It is not that the system doesn't work, it is usually a problem that is easy solve. He probably traded when there was a news release, for example. What people do not want to do is actually analyze those losing trades, find out, why did I lose? They do not want to ask themselves that question. Instead, they just say that the system is useless, and they move on to the next one. But the same thing happens with the next system, and they lose 1 or 2 trades, and then they move to another system, and the cycle happens over and over again.
How do you help people figure out why they lose?
One of my questions to a trainee was, when do you actually trade? His answer to me was that he goes to work, he comes home, has supper, spends a little time with the wife, and by the time he switches on his laptop and he gets to trading, it is about 8:00 p.m., South African time. He will place a trade, he doesn't get the profits immediately, and he will leave it on overnight. When he wakes up the next morning, he'll find that he has lost 20 pips. I immediately told the guy that he is trading at the end of the US session, and he's then heading into the Asian session, which is normally quite flat, and that is where his losses are coming from. I asked him if it is possible that he could trade between 7 and 9 a.m. South African time, because that would mean that he would be trading the open of the European session. So that was exactly what he did, and that was when he started to become successful. It had nothing to do with him or his system, but rather he was just trading at the wrong time of day. Self-reflection is key to becoming a profitable trader, in my opinion. You have to consciously make every effort to balance these activities with your daily activities and implement consistency in daily trading times.
Sound like it just falls back to what we talked about earlier, which is going back, reviewing your trading and seeing the mistake.
I think that people always like to shift blame to someone or something else, such as an indicator not working or the market is reacting weird. They have difficulty admitting that the problem or fault is actually themselves, and I think they need to make mental adjustments to be okay with that. You need to be very honest with yourself when you are trading.
What do you find is the most interesting part of trading itself?
I love looking at the charts and doing the analysis.
What's the most frustrating then?
Sometimes waiting for a trade setup to occur can be a bit boring and frustrating. In the beginning, there was a huge adrenaline rush. You will be waiting for a trade. You can see the signal building up, and it's getting closer and closer. It was like a roller coaster ride. But what I found was that it's not as glamorous as people seem to make it out to be. A lot of the time now, I just sit around and watch the screen, waiting for something to happen, and sometimes that could take hours, and I would get frustrated. There were even days before I had the robot, where I was away from the screen, and I would come back and realized that I missed the signals. What I find the most exciting to me now is the development of systems, getting them to work, and helping other people become successful.
Do you ever have a problem keeping yourself out of trades? For example, if you are trading the British pound and then all of a sudden, the Japanese yen has really big movements, you feel the urge to participate.
No. I've studied the euro, US dollar, and British pound, US dollar in particular, and developed strategies for trading these specifically. I believe that every currency pair is unique, so I stick to what I know best and have no regrets if I have missed a big move on another pair. To me, the bottom line is that I am making money, irrespective of whether it is in the Canadian dollar or the euro or the British pound or silver or gold. It doesn't matter to me where the money is coming from. That is the important thing, and I'm quite happy with the British pound, and I obviously now trade silver as well. To me, it all comes back to discipline. When I first started in the market, I would hop in just for the sake of being in the market. If I was bored of waiting, for example, I'll see the signal in the yen, and even though I do not really trade the yen, I'll enter simply because I wanted to be in the market. Then I would lose. And after having lost a couple of trades, I learned discipline. I'd rather just stay out because it would take 2 winning trades to make up a losing one, and I cannot stand losing. I look at it this way: by staying out of the market at the right time, to me that was actually a winning trade.
How is trading currencies different from trading silver?
Well, the primary difference is that silver moves very, very slowly. You need a tremendous amount of patience, because silver might only move 4 or 5 pips in 2 or 3 hours, but each point is worth a lot more money. I am earning $50 for every pip that's it moving. So, even though it's only moved 5 pips in the last 3 or 4 hours, for example, that's $250 to me. So I'm quite happy with that, but it takes patience.
So, are you ever competitive with your students or your brother in terms of trading?
No, I only compare myself with myself. I was taught from quite a small age to always give of your best, and my dad always used to tell me that even if you think that you're the best, you are probably not. There's probably somebody, somewhere out there who is better than you, so you always need to strive to be better. I think that is where he instilled in me the passion to learn as much as I can, the passion for traveling, meeting other people, learning about other cultures. What I've found was that with the silver now, I've got the indicators, I've proven the indicators work, and yet every single day I am still looking for something to make it better, and that just drives me.
Do you feel like you have changed a lot of your systems or strategies along the way?
It has really been fairly small changes, just little adaptations as I've discovered new things. There's one more thing that I want to talk about. When I started teaching people in the beginning, I realized that there was one thing that is terribly wrong with many new traders. They tend to open demo accounts with $50,000. These people will start trading this amount, and they will make money, or they will only incur small losses, because the bottom line is that it is very difficult to blow $50,000. Then these people feel confident and open up a live account with $300, and they start to lose money. It may be because they do not have enough capital to withstand the same amount of stop loss, or they cannot take as many lots as they could with a $50,000 demo account. Either way, they are trading differently, and it has a huge negative impact on how they are doing live. Therefore, I think that it is extremely important to ask for a demo account with a balance that you plan on funding with when you go live. This way, if you triple your account 3 times over like I teach people to do, you know that you are playing with the same amount of capital, and there should be no major surprises when you go live. That, to me, is absolutely critical.
Lessons from Hussein Harnecker. Triple your demo 3 times in a row. Hussein Harnecker has not had an easy life. Being born in a country that was formerly segregated by race, Hussein worked hard to earn enough money to start a partnership. When that partnership turned sour, he was left with nothing. It took him 6 to 7 months to save up enough money to start a $1,000 trading account. Yet his struggle may be the key to his success. Having gone through so much difficulty, Hussein has become extraordinarily conservative. When he persuaded his wife to let him give trading a try, he knew that $1,000 was his one and only chance to prove that he could make trading a career. That is why Hussein made it a rule for himself to triple his demo account 3 times in a row before actually trading live. Though this rule is exceptionally hard to follow, both in terms of patience and actual results, it is one worth implementing because it forces you to develop a trading methodology that has a substantial chance for success in real market conditions. For anyone who is serious about trading and who has the patience or discipline to earn your stripes before heading off to battle with the markets, this is a trading rule worth following. Focus on your pip target. Compared to many other traders, Hussein's 10 pip a day goal is also extremely conservative because, in certain cases, this is no more than the spread of a currency pair and is a fluctuation that can occur within a blink of an eye. However, at 10 pips a day, 5 days a week, 4 weeks a month, that adds up to 200 pips per month or 2,400 pips a year. At those levels, the numbers are not conservative at all. There are many different ways to make money trading. Some traders in our book aim for 200 pips a day rather than 200 pips a month. Both of the methods are sound, but for short-term traders who seek instant gratification, Hussein's methodology may actually be more suitable. You can always alter your trading size. On one standard 100,000 unit lot, 10 pips are worth $100, but on 10 of those lots, they are worth $1,000 a day. Focusing on the point potential may be more intelligent than focusing on the dollar amount. In order to lock in profits and to increase the probability of success, Hussein also uses trailing stops. For example, if his trade is up by 8 pips and goes back down by 3 pips to positive 5 pips, Hussein's robot will kick in and automatically lock in the profit. Once again, these singular pips may seem tiny, but we already know that Hussein's conservatism has paid off. Practice regular self-reflection. One of our favorite pearls of wisdom from Hussein is his practice of going back and analyzing his trades. When he first started trading, there were times when Hussein would incur a string of losses. In those cases, he would go back and revisit his trades to see if there was any pattern to those unsuccessful trades. We practice this as well. Even when we do not face a string of losses, every week we will reanalyze our trades to see how we could have improved them. This may involve things like timing trades differently, perhaps avoiding trades around certain news releases, or tightening up the stops. In fact, in our trading, we have found that when trades go wrong by more than 70 pips against us, they will end up in a loss 90% of the time. Therefore, what we learned going forward is to limit the majority of our stop losses to 70 pips. When you reanalyze your own trades, you will find ways to improve your own trading results. Chapter 6. The Wisdom of Experience. Frankie Law. Meet Frankie Law, the man who turned $200,000 Hong Kong dollars HKD into HKD $6 million. Having been in the business for over 20 years, Frankie is a big believer that success comes with experience and time. A technician at heart, he ranks price movements on an ABC scale, not in terms of complex indicators like Elliott wave patterns, but in terms of potential profit opportunities. He identifies a trading zone, commits to it, and scales down as long as the zone holds. His relaxed, simple, and philosophical approach to trading has served him well, and we were delighted to sit down with him for an interview in his office in Hong Kong. How did you get into the business of trading?
I started in 1986 and have been in this business for over 20 years. When I first started, Hong Kong just released the Hang Seng Index futures. The only other product available for trading besides the stock index futures were gold futures. Unlike the wealth of products available abroad such as oil, foreign exchange, merchandise, and bonds, what I had to trade were Hang Seng and gold, both of which did not have very high volume. After the 1987 crash, I wanted to trade something else. So in 1988, I started trading currencies, and later on I returned to trading stocks as well.
What sparked your interest in trading? Was it something that you learned in school?
20 years ago, we did not have the opportunities that many people do today in Hong Kong, so I only finished high school and never had the opportunity to go to college or get a CFA or CMT designation. The good thing was that this left most people on the same playing field with equal opportunities. Everyone started at zero. Even if you did get the opportunity to go to college, although there were economics classes, there were barely any classes that talked about investments. When I started in the industry, I started in the financial markets doing administrative work. I didn't seek out financial markets, but that came more by chance, and shortly after I realized there were many opportunities in the financial markets. That was when I changed my job and decided to become an investment representative. I was a broker who specialized in futures and then later on in currencies and stocks. Only after I became a broker did I begin to trade for myself. That was not until 1988 because, unlike some people who enter the industry with a pocket full of cash and are looking for investment opportunities, I saved money first and then used a portion of that money to trade, which is why I did not begin trading immediately. It took me 2 years to save up the money to do so.
Did you work a full-time job while you were trading?
Yes, I did on the side. My primary job at the time was as a broker and financial advisor.
How long did you trade stocks and oil?
Up to the present. Although since the beginning of 2005, I switched away from brokerage to focus more on education, and I trade stocks and oil on the side.
When did you start your own education company?
I started the company in 1992, but throughout that time, I was working as an investment advisor. It was only in the beginning of last year that I put my full-time focus into my company.
How much did you start trading with?
In 1988, about $50,000 HKD, which would be considered quite a bit in today's dollars. and is the equivalent of 2 years of savings.
Was trading easy for you in the beginning, or did you feel frustrated at the start?
Yes, it was definitely frustrating. In the beginning, I did face a lot of failure. I think that when it comes to investments and trading, in the beginning it's a cycle of failure, followed by success, followed by failure again and success again. But the last step is either success or failure, which is the same as life. You are faced with many success and failures, and my later successes come from the experience of my failures. This, too, is a repeated cycle. Even at times that I think I may have succeeded, I hit a stumbling block, which becomes another learning experience, and that has really been all part of my training to become a successful trader.
What encouraged you to keep on trading when you had failures?
Well, there is a very unique characteristic of trading, which is that the feeling of success and failure comes quickly. Today you make a trade and it becomes a loser, but tomorrow is another day. So, when I make a bad trade, I forget about it, go to sleep, wake up and start all over again tomorrow. Success is also very fulfilling, which is the main thing that pulls me back into the market. In other jobs or industries, the feelings of success and failure may not be as strong. When it comes to trading, every day, you get to experience the feeling of either success or failure. For people who like the feeling of success and drive, trading presents plenty of opportunity for fulfillment.
However, there are many people who face big failures that make it difficult for them to have the confidence to trade again. How do you prevent this from happening?
Personally, after many mistakes, I have learned that the most important part of trading is using stops because, at bare minimum, it allows you to control your risk since bad trades are unavoidable. Let's take a casino, for example. There is little chance that you will be able to win 10 out of 10 bets. As long as you control your betting size, however, it will allow you to retain some of your capital to play the game the next time around. Another thing that I don't like to do is to average down and post margin calls. There are many people who will go long a currency pair and keep injecting money into their accounts if they get margin calls, and buy at even lower prices in hopes that a rally will help them to recover their entire account. For example, if you are long 10 lots, if the price falls, you add 20, if it falls again, you add 30, etc. Although the ability to recover quickly may seem extremely attractive, it is very dangerous and it is something I will rarely use. I feel that if I keep on posting money into my account to meet a margin call and add into a losing position, I am essentially at the whim of the market. I can only hope that the trade moves in my desired direction, but I am stripped of my decision-making power. Perhaps the price movement would have called for a short, but since I am buried so deep in the long position, I can only let the market take me where it wants to. So what would I do if I got a margin call? I would close my position and wait for the next clear opportunity or setup to get into the market because it avoids letting the market dictate my profits and losses and allows me to be the decision maker once again. I get to choose when to get into the market, what product, and what size, and this control is very important to me.
How long did it take you to realize that stops are important?
It was something that I realized later on. I remember the first trade that I lost money, I did not learn that lesson. The second trade, I didn't as well, but by the third losing trade, I finally realized the importance of using stops. In addition to stops, there are other methods that I use to reduce risk. They include spreading out my entry levels so that I can spread out my risk as well as diversifying by product or entry levels. If I am very confident, I could put my whole investment into one entry, but I will scatter my exit levels. If I am not as confident, I would spread out my entry.
How long did it take you to develop a strategy that worked well for you?
In approximately 1998, when I started making changes to my trading style. So as you can see, it took approximately 10 years of success, failures, and essentially gaining trading experience for me to get where I am today. Although this may seem like a long time, since then I've had 10 years to act effectively on these experiences, which would be post-98.
Why did your strategy change?
After a series of failures, you want to change yourself because the right direction to look is forward, and the other reason for the change is age. Before you are 30, you are very aggressive. If you have $300, you could risk the entire $300. But after 30, you become more conservative. The younger you are, the riskier, the older, the more conservative. So I believe people change with age. which contributes to the reason why I began to change my trading style in 1998. After experiencing many different types of markets, I became more mature and realized that I shouldn't risk all that I have, and I should save some on the side. If I make a bad trade, I have learned to just give up on the trade rather than pressing further in hopes of making a quick recovery, as I may have done when I was younger.
So you only started to make serious money after 1998.
Yes, by that time I developed my technique and system. How much you make really depends on how much you invest. But if you have a good system, even if you make one bad trade, you can feel confident that your next ones may still lead to success. Your system and technique are very important. Getting into a good trade really involves having a good eye. None of us can guarantee that, so it is important to learn how to analyze the markets and to have a trading plan.
Have you ever taken any classes that teach you how to create a system or read charts?
When I started to get into the industry, there weren't that many classes available. These days, investment classes have become far more popular in Hong Kong, and the desire to learn more about investing has as well. But 20 years ago, this was not very popular. I read newspapers, financial magazines. I used Reuters, read charts, price levels, which was the way I learned myself.
What is your normal trading day like? How often do you trade?
I prefer a longer-term style. I will pick a direction, probably based upon last night's charts, and then determine my entry point based upon economic data and technical levels. I look at country news or political news, but I don't give much weight to it because, for example, if I am analyzing the Middle East situation, any information that I read in the paper will probably not be as up to the minute or as in-depth as the information that big banks or large investors may have. Information can be bought, so I am sure that there are people who know a lot more than I do. But if those people do something, the market will move, so if I look at the charts, I will see the activity. I may not know why they are moving the market the specific way, but I do know that people are moving it at the moment. This may give me enough information to enter or exit the market vis-a-vis a breakout or breakdown or a bounce off the average. This is the most common technique that I use to trade. I will also look at economic data such as upcoming interest rate movements, whether the US will raise or cut interest rates, whether the UK did so overnight, etc. Interest rates are extremely important in the FX markets. I will also look at charts and use both of that information in combination. The way I look at things is that on a normal day, a currency probably moves 100 pips. If you capture 50 pips during the day, that is already considered very good. If you capture 80 pips, I would consider that a cup. 50 pips is C cup, and this is a good way at looking at it to determine when I should stop trading. C cup is pretty good, I am generally happy with it. B cup is even better. A is the best, but rare and is basically a long shot.
Do you look at charts first, then economic data or economic data first, and then charts?
I will look at charts first because if you do, you can see what kind of trend is happening in the various currency pairs. This can also be a neutral point that you work off of. As for economic data, I use it on a much more short-term basis. For example, let's say that I got into the market and there is an important economic release due out tonight. I will consider whether it will most likely hurt or benefit my position. This is secondary, though. I think that the trend and the direction of the trend are most important. I will only look at data as to how it can impact my position.
How long do you usually keep your positions open?
On a short-term basis, I have tried to day trade. Day trade has two meanings to me. The first is that I can earn a large amount of money if the move happens in one day, so I would pocket that. For example, if I am long dollars and the US dollar rallied 300 points, I would definitely pocket the money because 300 points is far beyond what I may have considered for a daily move. So I would take it as a day trade and bank the money. On the other hand, if I was long dollars and the dollar is not able to rally, and I have some small profits like 10 or 20 pips, I may pocket that money as well. The thing is, when I go into the market and enter into a position, I will not think about whether this will be a day trade. To determine how long I will hold a position, I look at the charts to see how long previous trends have lasted and how long the current trend has been in the works. In these situations, I would be perfectly comfortable holding a position for as long as a month. When I hold positions for a month, one of the most important things that I will always consider is interest. There was a time when I felt that US interest rates were very high, so I went long the US dollar against the Swiss franc and Japanese yen because, if I am holding the position for a month, I will know that at least I will earn the interest. If I felt that the outlook for the US dollar is weak, I would short the dollar against the British pound because at the time I would earn interest going long pounds against the dollar. So I will pick a direction where the interest is favorable to me. This is important for longer trades because the amount can be significant. The interest that you earn is increased by the usage of leverage, so it can be a large amount. This is exceptionally important for medium-term traders. For short-term traders, interest is not important because there is only a limit to how much interest you would end up paying out.
How long did it take you to figure out the importance of interest?
Not too long after I started trading. The great thing about the FX market is that you have a choice. I can pick to earn or pay interest. If I didn't have a choice, I would have to pay the interest, of course. However, because I do have a choice, I would definitely pick to earn interest. I can go short or go long dollars and still earn interest. It's just a matter of which currency pair. It's not always easy because some pairs have narrow interest rate spreads and others have wider, so you may not always know which one to pick.
What currencies do you trade the most?
The Swiss franc, I will spend the most time there. I like it because of the larger volatility. The euro is good too, but sometimes the volatility is not as big. When I trade, I usually will look at price charts and overnight Dow Jones activity. I think this is enough.
What type of equipment do you use?
I will use basic free charts. I think that trading FX these days is much better than in the past. Back then, more sophisticated people would use Reuters, but that can be very expensive. I was also previously sponsored by Reuters to use it for over a year, but afterwards I did not opt to pay for it myself. When it comes to information these days, there are many places to get it for free, and during that time you can see how the price moves, which is as reliable as it gets. Reuters sometimes has false prices, like the highs and lows may be indicative and not actually executed prices. I prefer to watch the dealing station in real active times because then I can see more reliable prices that are probably being dealt at the moment.
So you don't think that an average person needs very expensive equipment, similar to what banks have to be successful?
I think that it is not necessary these days. In the past it was. But in the present information is more fluid, so it allows you to avoid paying up for those services. Also, I don't think that people should not get it just to save money, but because many of the cheaper or even free resources out there are sufficient, if not better. Capital is important when it comes to trading, and there are some costs that should be made initially, such as a fast computer and connection, but other things are not as necessary.
Sometimes the timeliness of certain services may pale in comparison to Reuters or Bloomberg. Is this a disadvantage?
Usually, you know in advance when data is going to come out or when speeches will be made. Sometimes you have scenarios like 9/11, but that is very rare. I don't feel the need to know the data the second or even minute it comes out. Most services will release it shortly afterwards, and you can watch the price for the reaction. If you are really worried about the risk, you could call in and put a stop or something. When there is a large, unexpected event, there is not much that we, as small investors, can do about it. We find out as quickly as we can, and the key is to focus on reducing risk on the back of those events, to put in stops as often as possible. Most investors cannot afford a Reuters or Bloomberg, so the key is to focus on finding your most reliable news sources and then watching the price. Sometimes the price can lie too because it can be late in updating, so make sure you look at a few different charts.
What time of the day do you trade?
I don't really split between times. Usually I prefer at night because it is more relaxed and quiet, and as such, I have more time to look at the charts in finer detail.
The afternoon in Hong Kong is basically London Open, and the evening is the US Open. So is it better to analyze the markets then because there is more activity?
I think that certainly is a reason. If the market is moving a lot, you get to see a lot more information and understand the currency's reaction more. Sometimes watching the markets may require a 1-hour, 2-hour analysis or just a quick glance at the charts. You can even set alerts. What I like to do is to use a price quote beeper that shows how prices are moving. This is great when I am sleeping because I don't like to have to wake up constantly to check the price quotes. You can also put alerts on your computer, but you may not be able to put that next to your bed like you can a beeper. Instead, with the beeper, I can set the price levels that I am watching and it will alert me when the price is hit. When the alarm rings, I know that something unique is happening, and I can go look at my charts to see if I want to do anything. It's impossible for me to watch prices constantly, especially if I am in a meeting or teaching a class. It is also impossible for me to bring my computer with me into the meetings as well. So a price beeper is a perfect tool for me to use to keep on top of the markets.
When did you start using the beeper?
In the 80s, these beepers were available before the 90s. They have changed a lot since then, of course, and are very inexpensive and cheap to use. On a monthly basis, here in Hong Kong, it can cost $300 HKD a month. Now, one thing, these beepers are convenient and inexpensive, but you cannot rely on them 100%. Sometimes with wireless connections, updates can be slow, especially if the market is moving very fast. It definitely won't be as fast to update as your cable internet or DSL connections, so the beepers should only be used as a secondary support tool. In typical scenarios, it works well. But if there is a major interest rate decision or a political development, it can be a bit slower because the connection speed can be a bit slower.
Typically, what time frame charts do you use?
I will use daily charts and minute charts. Daily charts are for direction to see where the trend line is pointing. If the daily charts indicate that the currency pair will rally, I may want to avoid making shorts on a shorter-term basis. The daily charts can show the general direction. I use the minute charts to determine whether the price is the best price to get in at. If I am looking to buy into a trend, I want to get a nice price, which is really the benefit of using shorter-term charts. If the minute charts show short-term weakness and the potential for a 20-point dip, then that could be a 20-point better entry for me.
Do you think 1-minute charts are really more reliable and better than 5-minute charts?
I feel that the 1-minute chart gives you a closer, more instant look at market behavior and is a truer reflection of current market activity.
Have you always used the combination of daily and 1-minute charts? Or is that something that you discovered later on?
It's definitely a technique that has evolved. I feel that when it comes to trading, one is always evolving whether you realize it or not. It's all about change for any investor, including myself. Right now, if you ask me if I have the best strategy, I may say yes. But in a year, things may change and a scenario that hasn't happened in the past may have happened. As a result, I may have to react to that as well. It's all about challenging yourself to adapt to the changes.
Do you feel that the changes along the way have been big?
I think it really has been a small evolution along the way and not a big change. Training yourself to be a good trader is not like rebuilding a house, where you can completely strip the old house and its foundation and start from scratch.
There are some people who start as a trend trader and then switch to become a range trader or vice versa before they find their true trading style. Has this happened to you? Have you always been a trend trader?
I think that I have always thought in the mentality of a trend trader, just not so perfectly and with as reliable trading strategies. Most people are this way with the things they do. For example, if you like martial arts and kung fu, you may begin to do some of the motions. But at that time, you may not know or consciously care about whether the motions are karate style, taekwondo style, or jiu-jitsu style. Only after you learn and practice more and more and become a true student of the art do you realize that your motions may actually be taekwondo and not karate. The same is with trading. Some traders may start out trading one way, maybe as a momentum trader who rides the wave of price, or a reversal trader who always tries to pick a top. They may not realize what category they fall into until much later on.
When you first started trading, how many hours a day did you trade for? How long would you hold your positions? Has this changed?
As for how long I would usually spend trading, I consider every time I check my quote rates on my beeper as part of trading. Every day I do look at the markets, more so at night. Generally speaking, the time that I spend at night sitting down and really analyzing the markets is usually under an hour. The reason is because usually when I have already identified the major trend in the market from a broader scale, I already know what I am looking for on the charts on a daily basis. That is, if the trend is still intact, is it losing momentum? Or has it already been compromised and ready to reverse? Some people find trading currencies very difficult because they feel that they have to spend a lot of time watching the markets since it is open 24 hours a day. I don't think it should be the case. When I trade, it is usually very relaxed because all I do is spend a little time every day looking at how the market has moved and how that movement plays into the overall trend. And from that, I have usually identified the key support and resistance levels, which I then enter into my beeper machine. Any levels within the support and resistance zones I am usually very comfortable with. The only times that I need to keep an eye on the market is when my support level is breached in an uptrend or resistance level is breached in a downtrend. But regardless of the direction of the trend, I will usually check my charts if either the support or resistance zones have been broken to see if I need to react to it. This is the main reason why I think trading is very accessible and easy for individuals. All you need to do is to make sure all of your eggs aren't in one basket, diversify, identify a direction, and figure out what the top resistance level and bottom support levels are. Movements in the market on a daily basis are very normal. If there were no movements, I would probably not want to trade. I just don't become obsessed with the market. I want to wait for a good time to get into the market and go with the movements. 10, 20, 30 pips on fluctuations are very normal. If I become nervous when the market fluctuates 10, 20, or 30 pips, that may be more of a problem with myself than with my position. This, of course, is if you trade like me and look for big moves. I'm only worried when it moves beyond my predetermined amount, i.e., breaks a key level, and that is when I will revisit my position to see if I need to make changes. Therefore, even if you have a full-time job, you can be active in the market as well. Just have some sort of alert system either via email, which you can set up some charting packages to do, or subscribe to a beeper like I have. It doesn't require you to watch the market 24/7.
How many pips do you look for in an average trade?
Usually I look for at least 75 to 100 pips. The good thing about currencies is that there isn't much cost involved. If I trade a currency pair with a 5-point spread, I view that as my cost of trading and will usually be satisfied with making 50 to 100 pips, which is quite lucrative for a 5-pip cost. If the currency pair has a wider spread, I will usually look to make more pips than that.
What is your stop usually?
It really depends on whether I am looking for a shorter term or longer term trade. But usually what I like to do is to exit in increments. If it moves 75 to 100 pips, I might stop out a portion of the position. If it continues to move another 75 to 100 pips, I might exit another portion and so forth. I really like this exit strategy, and it is something I have only started using in the past 10 years. However, I only do this when I still believe that my directional bias is correct. Keeping a portion of the position allows me to retain the ability to turn this trade around. I have used this technique in the past year, and it has worked out for my trades on many occasions. So I may put one stop at 100 points, another at 200 points, and another at 300 points. I do the same thing with profit targets. I will begin to slowly take a portion off the table in increments. If I make 100 pips, I may close out a quarter of my position. If it moves another 100 pips, I may take profit on another quarter, and so forth. This basically prolongs the life of my trade in the market, which I think is important for trend trading.
So it seems like you always trade in multiple lots then.
Yes, I have quite a bit of speculative capital dedicated to trading currencies. When I trade and have confidence in my analysis, I may put my entire speculative capital into the investment, but manage my exits more aggressively by spreading them out.
When you trade, do you usually focus on one currency pair at a time, or will you hold positions in multiple currencies?
I usually trade one currency pair at a time because if I trade too many, I will not be able to focus on my positions. So if I am trading Swiss francs, I will only focus on the franc. Then if I want to move on to yen, I will wait until I exit out of my franc trade before taking a yen position.
What kind of leverage do you use?
Usually the maximum leverage offered. In Hong Kong, that is 20 to 1.
When you first started trading, did you use your savings, or did you borrow from the bank?
It was basically my savings. Personally, I do not believe in borrowing money to fund my investments. I use my own funds.
Do you have some sort of monetary or pip target every day or week?
No, I do not have daily or weekly targets. The main reason is because I do not want to stress myself out. If you have a daily or weekly target, you are making trading a necessity. That is, every day, you are forcing yourself to look for a trading opportunity, even if there may not be one. I prefer to wait for an opportunity and then take it. I don't want to be forced to trade to meet a target. I would rather wait for an opportunity or setup to occur and then to act on it. If I see opportunities, I may trade more. If I do not see an opportunity, I will opt to preserve my capital and wait. I feel that having targets could actually erode your performance.
Have you ever traded full-time?
Initially, I was an investment advisor, so trading was not my full-time job or focus. Only in the past few years, after I have been successful, have I switched over to giving education courses while trading at the same time. As you have mentioned, there are indeed people who trade full-time. For those who do, I suggest they look more at the longer term. That is, to have a quarterly instead of a daily target. This allows you to more flexible. For example, if you need to make $30,000 a quarter, you can revisit your records every month to see how you are doing to meet that goal. This way you avoid the situation where you have a $300 a day goal, and because you lost money yesterday, you end up overtrading because you need to make $600 instead of $300 the next day.
What about life expenses? Like rent, healthcare, and the like, how do you deal with that?
Well, I am fortunate enough that I do not have that many expenses. I own my property, so I do not have to pay rent. As for spending, I do not have high expenses, so that is why my stress is not that high. As for my education company, there are expenses, but the income from the business is relatively steady, so there is no major problem. To me, the most important thing is that when it comes to my trading, I do not have stress. No stress to meet a goal, no stress to make money to pay my rent, so I do not feel like I have to force myself to trade. Therefore, I have no need to make any quick cash. I can sit with my position and trade only when opportunities arise.
Do you do your own taxes?
In Hong Kong, you do not need to pay taxes on your trading profits. But at the same time, if you lose money, you cannot use the losses to reduce taxes. This is as far as I understand, but an accountant would know the details far better. This is for stocks and currencies. Property/real estate gains, you have to pay taxes.
Did you have a mentor when you first started?
I had colleagues in my company that taught me the basics.
Did you ever join a support group?
No, because 20 years ago there wasn't that many advanced services for trading. Support groups did not exist. These days I will sometimes attend a lecture, but not really take classes because now that I have been in the industry for 20 years, I feel that I have enough experience that I do not need to take any of the classes.
Do you recommend classes for new people?
There are a lot of things to learn in the markets, but learning yourself could involve a lot of time and a lot of brick walls. You may spend time looking at tools that may not be right for the market that you want to trade. These days, there are many classes available which help start traders on the right foot and ease their learning. But don't expect to take a class no matter how expensive it may be and be successful right away. The class will give you knowledge, teach you techniques, help you to develop a trading plan, and through this knowledge, you will learn the product's characteristics, and after that you can learn to develop trading techniques. A class helps people to accelerate their learning, take the first step. But just accelerating your learning will not guarantee success. If it did, everyone would pay a few $100s for one class and never go to work again. No one will teach you the main secret to trading. It is a matter of how aggressive you are at learning and your talent at picking up the information.
Do you have a number one rule for trading?
Yes, stops. The number one rule I have is to use stops and to diversify your investments and do not be afraid to lose. There will always be risk. There are many people who analyze intensively for hours, days, or weeks until they find a trade that they have 90% confidence in. But there is nothing that can be 90% right all the time. As long as you find something that may only be 80% right, that is good enough because it still means that it only has a 20% likelihood of being wrong.
What about fear of losing?
I think that the more you are afraid to lose, the more unsuccessful you will be. You will be over-selective and find that you have missed opportunities. You need to analyze and do your homework, but you also need to be willing to take the chance to take the risk. If you are wrong, that is okay as long as you have a stop in, your stop will be taken out, and your loss is limited. Maintaining limited risk is better than missing out on what otherwise could be great opportunities. Making sure what your worst-case scenario is at any time will help you manage your trades better, which will ultimately lead to more success.
What was your most memorable trade?
It happened 2 years ago. I took a trade and was able to make 40% in 1 week and a bit more. This was in August 2005. At the time, I was long $5 million US/Swiss francs. I added 2 million later, totaling 7 million. Then I held them both at the same time for 8 days, before getting out at a 40% profit. At the time, US dollars/Swiss francs was range trading and it was nearing a key support zone. I checked my charts and saw a minor breakout and felt that it was a good point to enter into the trade. I initially bought at 1.2487, then I went long again at 1.2485. I exited the whole position at 1.2737, which was the fastest time I exited out of the trade with such large profits.
What was your worst trade?
It was in June 2005. I lost close to half of my investment. I was long 5 million British pounds/US dollars and then added another 4 million. I had small profits at the time, but then got greedy and added another 5 million. Then the market reversed and collapsed, and because I was long so many lots, I incurred huge losses. The problem here was really my greed. It caused me to let a winner turn into a loser.
How did you recover your confidence after this?
Winning and losing are all a part of trading. If you believe in your system, you shouldn't let it get to your confidence because you will be able to trade again and hopefully make the money back. Even though I lost half my capital, I still had the other half, so I had the capital to recover my prior losses. I think that capital preservation is most important.
Did you learn something from this trade?
Definitely not to be greedy. If I have profits, I now look to pocket them. At the time, I was hoping for a big ticket winner if the position moved in my favor, ignoring the risks. It's a mistake I won't make again. At the time, I lost close to $200,000 US dollars.
When you look at charts, do you add indicators?
Yes, MACD, moving averages, DMI. My charts are generally very simple, only a moving average on top and then maybe either the MACD or DMI on bottom. If there are too many things on the charts, I think it's confusing. I don't think you need to put too many things onto the charts. It's important to analyze when trading, but because every indicator is different and may give different entry signals, you can get more confused rather than more clear. I don't rely on too many indicators. Picking a few key ones is enough.
You have already said that entries are important, as well as scattered exits. Which do you think is the most important?
I think entries are the most important because if you enter well, then it gives you a good price to work with. But I also think that exit is also important because many people will enter in the market, have profits, but because they do not exit properly, the profits will turn into losses.
Lessons from Frankie Law. Cut your losses, retain control. For Frankie Law, trading is all about retaining control. Our favorite piece of advice from the Hong Kong-based trader is to make sure that you never lose control of your position because if you do, you will also lose your power to make intelligent decisions. Frankie believes that it is extremely dangerous to average down or post-margin calls on a losing position. Although you are lowering your average entry price, requiring a smaller price movement to return to break-even, every point move against you also becomes even more damaging because of the increased position size. At this point, you are essentially at the whim of the market and can only go where it takes you. Even if, based on your analysis, you wanted to take a trade in the opposite direction, you may not be able to because you are paralyzed by your losing position. Therefore, sometimes the smartest trade to make may be the hardest one. If you cut your losses, you not only end the pain, but you also regain your decision-making power and can examine the market from an objective point of view. Averaging down increases risk, averaging up decreases it. Instead of averaging down, Frankie averages up. In fact, many of the traders that we have interviewed also trade this way. By averaging up, you are actually lowering your risk because you are risking profits and not original capital. Frankie also tries to milk his trades for everything they are worth by scaling out of his positions. This prolongs the life of his trades and allows him to capture as much of the trend as possible. The way he exits is based on what he feels is the potential of a move, which is his methodology of ranking movements. What we like about Frankie's style of trading is the fact that he ranks the potential movements of a currency. For example, if prior breakout moves have lasted for 400 pips, and the current move has extended by 100 pips, you can consider that the move is only beginning to run its course and may elect to take off 25% of the position just to bank some profits. If the move has extended by 300 pips, then the move is nearing its potential. At this time, traders using a ranking system may elect to take off 75% of the position. A small percentage of the position is kept on with a trailing stop in case the current trend has the momentum to extend beyond 400 pips. This way, you are riding as much of the move as possible while also locking in profits along the way. Rank your profits. Day traders may also find it useful to employ a ranking system. For example, if a currency pair has a daily average range of 100 pips, trying to bank all of those 100 pips on a given day may be very difficult. Aiming to bank 30 to 40 of those pips on a day trade is very feasible. 50 to 70 pips may be harder but still possible, while 80 to 90 pips may be extremely difficult. This could give traders a frame of reference of when to take profits on their day trades by controlling their greed.